BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Making this sort of change for that top 0.3% of taxpayers, equalizing ordinary income and capital gains would restore fairness and do so in a way that wouldn't significantly affect investment and that would allow us to make really high return investments for which there's been broad bipartisan support.
That was Brian Deese, the National Economic Council Director from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Farrow. Tuesday morning, here's the price action. Your two-day Fed meeting commences down in Washington. Equity futures basically unchanged, up 3 points on the S&P 500 to 41.82, positive not even 1/10%. Our production team pointing out $18 trillion worth of the S&P 500 reporting earnings this week. Yes, really.
Very nice.
18 trillion. What a lineup for you. Wow. A little bit later, Microsoft. In the bond market, yields higher by a single basis point to 158 on a 10-year, Tom, and just short of 121 on euro dollar. Slightly negative, Tom, 120.70.
Oh, yeah, Fed meeting tomorrow as well. Maybe that'll move us off stasis in the bond market. It's certainly there. There are some trends upward, and we'll watch Microsoft carefully this afternoon. Romain Bostic will have all that on the close. Right now, we go where we fear to go with 74,454 employees, and that would be the infernal revenue system. Martin Schenker joins us, our editor-at-large, managing editor for taxes here at Bloomberg. Once again, the IRS tax season extended because of the pandemic. And I go back to a heated meeting I had with handsome Mark Everson, who was IRS commissioner during the younger Bush administration. And he promised and promised and promised and promised. Nothing happened. They were going to raise the budget, raise the money. They were going to bring in more revenue. It didn't happen. Let's start with what? Let's start with the why. Why doesn't it happen?
Because, when you get down to it, lawmakers are a little concerned about the issues of a very strict IRS enforcement on the population and their constituents. They hear from them when the IRS comes knocking on their door.
You and I have visible income and all that, and,
right.
I'm honored to say I'm in a tax bracket that's, forces one. It's a transitory tax bracket. There
you want
we
to go there, Tom, right now? Tell us more, please.
Transitory.
He's spreading it.
Let's have
Okay,
that
this
conversation.
is about small business. This is about hiding millions and billions. Larry Summers says $1 trillion.
Yeah, and, this isn't the first time an administration has said, look, let's spend the money to do enforcement, and we're going to get multiplier effects of returns. 80 billion will get you 800 billion is what the New York Times is reporting the Biden administration thinks. But getting it through Congress is another matter.
John, this is all about small business, entrepreneurial business, going to their politicians and saying, maybe not.
Well, Tom, I think it's something else too. Restoring fairness costs money. But also, if you can restore fairness, and even if it costs money, if you can make more money, Marty, isn't that the key here?
Yeah, I mean, that's their argument, that if you, for every dollar you spend on IRS enforcement, you get $10 back. That's been basically the argument over the last 3 or 4 decades. Way back in Wilbur Mills's days, they've talked about increased IRS enforcement, but it just never happens.
Can you make the same argument with capital gains north of 30%? Can you say it restores fairness, but also leads to higher revenue for taxes as well?
Well, I mean, fairness is in the eye of the beholder, right?
Yep,
I
true.
mean, if you look at it, only affects 0.3% of the taxpayers. You wonder about this whole question of fairness when it's such a narrow amount of people that it affects.
There's a question, Marty, about whether the tax hikes are in order to pay for some of the plans that Biden has, or whether the tax hikes in and of themselves are trying to impose a fairness. Basically, Senator Warren holding that fairness in the tax code hearing in Washington, D.C., starting at 2:30 p.m. Eastern. Do you have a sense of that? In other words, are tax hikes sort of on the table regardless of whether the $2.3 trillion plan get passed, as well as the $1.3 trillion follow-on about American families?
My impression is yes, that no matter what happens to the second stimulus effort, that they are determined to make wealthy individuals pay more, and that this is a philosophical argument as much as a fiscal one, and that the Biden administration, which can impose these tax increases with only 50 votes in the Senate, is determined to do it, no matter what.
How much Democratic support is there for this philosophical argument, given the fact that a number of them come from higher tax states, with actually possibly even a majority of people fitting into that tax bracket counting themselves as Democrats?
Yeah, well, they are really holding fire until they see how this plays out. But as we all know, the SALT issue, the state and local tax deduction, is a very emotional one for many of the representatives and senators from California, New York, and high tax states, and they're not going there unless that gets addressed, and that makes it very complicated.
Marty, the census, we got the first look yesterday. I thought it was really interesting. We get more later. The big city analysis comes later. Really interesting.
Yeah, and what the fascinating thing for me, it was like 800 people was the difference between New York keeping its representation and not. You know, I think we may overinterpret this. If Texas gains a seat, does that mean that that representative is going to be a Republican? When, in fact, Texas is becoming a more purple state and has been for the last decade. So you just don't know how it cuts.
Marty, great to catch up. As always, Marty Schenker there, Bloomberg editor-at-large. And I think in many ways, Marty nailed it then, Tom. Is it about a philosophical issue or purely a fiscal concern? And I think many people would conclude...
Oh, you mean taxes?
Yeah, and they lean towards the former.
John, I've been
allow me to finish,
This
Tom.
is nothing...
Just allow me to finish. I'll get
I get
there.
upset
I promise
about
you I'll
this.
get there. I'll wrap things up. I promise you. I'll get there. I'll get there. My question would be whether they have the mandate to actually have this huge philosophical change in the approach.
This is nothing more than a Schedule C debate, John. This is not about the 1040. It's not about visible income. It's about a huge body of America who's entrepreneurial. They make a lot of money, and they take a lot of deductions, and that's what they're going after. It's all there is to it.
Did you ever play that game at school when you passed something round, Tom, and everybody had their time? And they just got to talk and they weren't interrupted.
John, I mean, on taxes, I think the coverage has been baloney. We're funneling in all the rich people into one group. That's baloney.
Tom, I agree with you.
This is about deductions. Mark Everson failed at this 4 administrations ago.
I think you're revealing your bracket a little bit, Lisa, don't you?
Look, I think that there are many different debates here, right? Because what you're talking about is the IRS and the crackdown, the $80 billion investment that Marty was talking about. The idea of capital gains taxes, though, isn't about closing loopholes. That's about raising taxes wholesale. And some people might say that actually will open up more loopholes so that people can get around this or try to get ahead of this. The key issue, though, John, to your point about the philosophical argument is how much does that have clout? Does that hold sway over a party that actually is pretty wealthy, right? I mean, if you look at this is a populist message that speaks as much to the Trump voters as it does to many of Biden's voters. So how much cohesion is there among the Democratic Party to get this through, John?
Fired up this morning. Lisa Bramage, Tom Keene, Jonathan Ferro. I'm pretty chilled, to be honest with you. Coming up, Jack Ablin, Crescent Capital Chief Investment Officer and Founding Partner. Looking forward to that. Equity futures shaping up as follows on the S&P 500, up 3. We're positive 0.1% from New York City this morning. Good morning. Your yield is up a basis point on a 10-year to 157.92. Euro dollar 120.70, coming down about 0.1% there. And crude positive 0.8%. $62 and about 40 cents. It's going to be okay, Tom. It's going to be okay. A beautiful New York City. This is Bloomberg.
is absolutely core to our business. It's almost 20% of our franchise revenues globally.
I am placing a new order to sell short Japanese yen. So if you're looking to trade Japanese yen, the price I'm looking to sell 108.335. Let's see if I'll be able to fill this order. Okay, 108.335. I placed an order to sell short. So if you're looking to sell Japanese yen, come on, you can do it. If you want to find out more about our strategy, you need to go to companyi.co.uk website and you will find the strategy. You need to buy the strategy. We don't give it for free because we don't give it for free. Okay, I'll speak to you later, guys. Stay safe.
Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
From New York City, this is Bloomberg Surveillance alongside a fired-up Tom Keene, excited, I think, about the two-day meeting at the Fed beginning, alongside Lisa Bramett as well. I'm Jonathan Ferro. Equity futures on the S&P, positive about 2 points to 41.81. On the NASDAQ 100, we're positive almost 0.1%. No big moves here. $18 trillion worth of earnings on the S&P 500 this week alone. What a massive number. Talking of big numbers, switch out the board and let's get to this. Let's talk about banks. Not any particular bank, just banks. It's interesting that you would have a bank that would talk about clients needing to disclose more when the bank themselves hadn't disclosed that they took a hit from a certain client of close to $800 million. Not talking about anyone specifically, but here's UBS, down by 3% in Swiss trading this morning. What is material if it's not close to $800 million? Is it in the context of what happened with broader earnings? Maybe. That was certainly the message that we got from Morgan Stanley as well. So there's your Swiss mover. Let's finish on this one, Tom. I'll finish in the bond market for you. 2s, 10s and 30s. Yields higher by about a basis point to 158 on a 30-year to 226, up about a basis point. Lisa went through some of the supply issues through the week so far. 2-year a little bit soft yesterday. No big deal, though. We'll march through the week with more supply into that Fed decision, Tom, tomorrow.
The earnings out, and it is a blur. We're not going to go through the granularity of, say, General Electric or Eli Lilly earnings, but we are going to find the touch points that describe the larger picture. GE out with a organic revenue growth that is single digit, and Eli Lilly down, I believe it's 3% roughly, on the challenges of margin and the mix of business. Jack Ablin joins us now with Crescent Capital, their chief investment officer. It seems within a boom economy, Jack, that away from big technology, away from some of the winners, there's a real industrial struggle out there for growthiness. Why are the corporations going to struggle here given a boom GDP economy?
Yeah, I think we still are trying to, rebuild the supply chain and get a product to where it needs to be. I think some of the issue that we're seeing from the industrial companies is just rebuilding. So, some of it is translating through at least to some higher prices. I'm seeing now NFIB, the National Federation of Independent Businesses, something like 60% of their constituents saying they're planning to raise prices. Many already have.
Is there a public out there to accept those higher prices?
For right now, there is. Some of it, perhaps fueled by, $1,600 checks. But overall, I think we do have a consumer public that, has the wherewithal to sustain these higher prices. And they already have. I mean, the most striking inflation number in March, I think, was pretty strong.
Where is that consumer price tolerance specifically? You find it pretty broad-based? Do you find it within sectors, certain sectors specifically? Jack, where do you find it?
Sure. I think mostly clearly on the investment side. We're seeing it in housing, of course, and anything related to that. We're seeing it a lot of it in construction and so forth. Food, energy. It looks like it's pretty much all over the place. I think that, you know, where perhaps consumers are turning away some are remarkably on staples.
Do you think this gives birth to some kind of virtuous cycle?
Position opened on Japanese yen at 108.335. Just right here. Okay, so all of you guys who managed to open position, well done. Paul, stay with me. I will guide you through all trade, this trade, and we'll make a profit on it. Okay. And I'll speak to you later. Stay safe.
The Fed is telegraphed a do-nothing policy for the time being.
Jack, even though you do expect bonds to lose value, yields to rise, your recent note said that you're slightly underweight equities and are funneling cash into gold instead. Can you explain why?
Sure, it's really more of a hedge than anything else. I think what we're arguing is, look, you know, financial assets are generally there to preserve purchasing power, and if real rates are negative, financial assets don't serve that purpose. So what would serve that purpose? Gold, which has had a history back to Agamemnon of preserving purchasing power. Yes, it does it at an interest rate of 0, but guess what? So do financial assets right now. So the incremental disadvantage of gold is nil, and we can preserve purchasing power in the meantime. As a hedge, it's also a hedge against the Fed sitting their hands too long. It'll be great for stocks, and we would be underweight, but it'll also be good for gold.
We all appreciate a Tuesday morning Agamemnon reference, Jack. There is a question, though, about equities being also an inflation hedge and certain equities being more that way than others. Do you find that there are some that you can go into?
Different, yeah. I mean, I think cyclical certainly are a good way. We also have developed a strategy for our clients. That's what we call quality dividend. These are companies with not only strong balance sheets and the ability to maintain and raise revenues, to raise dividends, but they also have pretty strong pricing power. So that's been an area we've shifted away from, quote, pure balance sheet quality into quality dividend as we're, kind of navigating this next wave.
Jack, the next wave as well. The boom economy is going to end at some point. How do you hedge the tail to the boom economy?
Yeah, I think that's, a huge issue. I think part of it is, we're going to see some valuation contraction. One of the things we note is over the last decade, between 2010 and 2020, that roughly 180 percentage points of the S&P's 280% move was simply valuation expansion. And when interest rates got to 10-year rates got to 0.5, I think we recognized that valuation expansion isn't going to be part of the cards for a while. And so we have to turn our attention to just pure organic earnings growth and dividend yields. And when you look at the market from that perspective, cyclicals are better positioned than growth, just simply because the PE ratio, the reciprocal of the earnings yield is lower. And so historically, if you strip away valuation expansion over the last 10 years, value stocks have outperformed growth, or cyclicals have outperformed growth by about 1 percentage point a year.
Since Lisa's going lyrical here, I'm going to go all Def Leppard and Armageddon it. I mean, forget about Agamemnon. We're going to go Armageddon it. Yeah, get it all. That's the way we feel right now, Jack. We feel like, this is it. Everything's fine. What do I not want to own for when Armageddon comes?
Well, I mean, I think with the slowing, there are a lot of pretty stretched valuations right now. Low quality companies, these what we'll call zombie oriented companies that are running like crazy. call it, whether it's, I'm not going to single out GameStop, but certainly that ilk. A lot of speculation in the market. I think that while, it's hard for me to get my arms around Bitcoin, it's certainly not a currency. If it were a currency, it would have a volatility that was probably 7 or 8 times lower than it is right now. So part of the reason we chose gold over Bitcoin was because of that consistency. So, yeah, I think you want to be out of, just a lot of the companies that are trading a PE and a hope right now, and I think that's going to be that's going to be difficult. Keep in mind though, Q2 and Q3 we're going to see nominal GDP rates near 10%.
Massive numbers.
So I think we're going to bask in the glory of very, very strong growth, and I've been wrong a lot before, but I defy the 10-year to stay at 1.6 when we've got nominal GDP at 10.
We'll see. Jack is going to catch up. Jack Ablin there, Crescent Capital Chief Investment Officer and Founding Partner. Let's talk about those zombie companies. What is a zombie company, Tom? Is it a company dependent on low cost of capital, or is it a company dependent on the low labour costs that have dominated the previous cycle? My colleague, good friend Lorcan Roach Kelly here at Bloomberg, bringing up that point in the last couple of weeks, and I think it's a really important one. We're about to find out who are the zombie companies who have been dependent on very low labour costs. Let's see what that looks like in the next couple of quarters.
Okay, I'll go there, but I really want to go to the cost of capital, and to me, the idea of the persistently free lunch. And John, this goes to the real yield. Folks, look for the real yield on Friday afternoon to drive forward the yield less the inflation cost. And John, the artificiality of where the real yield is just flat out the reason zombies exist.
Whenever you're naughty, you always promo that show. Always. That's just the Tom Keane thing. Does something wrong, comes back and promos the show this coming Friday. Lisa, you've written about this recently, zombie companies in America and worldwide.
The issue here is there are a lot of companies that perhaps would have gone out of business if it hadn't been for the largesse of the Federal Reserve. What happens to them? What do they do to the economy given the fact that they continue? And will the Fed ever let them fail? I can't imagine we're going to see mass defaults in the near term.
This is the counterpoint to this. Was it the Fed that kept it too loose, or not loose enough for long enough to allow the labour market to tighten and for wage costs to come up? Who are the real zombie companies? And I've heard several people talk about this, not just Lorcan, but also Joe Weisenthal too. And I think it's a really important conversation. If you'd allowed the labour market to get tighter, to actually see real wage growth, would the Ubers of this world survive? Higher wages, would they survive?
I would suggest, and this is with 3M just coming out, Minnesota Mining out with, another Minnesota Mining report. Lisa, is 3M a zombie company because they can't keep up with big technology?
All I know is that my kids buy plenty of Scotch tape, so we're trying to keep 3M alive single-handedly. Okay. There is a real question here about wage hikes and also just sort of how nimble this economy is, John, to change to a very changing dynamic both in labor markets and potentially in debt markets if we do get inflation.
Nice write-up on a Bloomberg today on this inflationary story. The latest ISM report, which I'm sure many of you saw, showed the share of manufacturers saying their cost of inputs rose last month close to a post-2008 high. This is a thing for us this morning. We'll stay on top of it for you. Tom Keane's got more to say.
I go Sheffield with Def Leppard, and I get nothing from you.
Tom Keane.
I give you a Def Leppard lyric.
Jonathan Ferro, I missed it.
I got nothing.
I'm not sharp this morning. I missed it. I'm sorry. Coming up, Dr. Ramesh Adalja, Johns Hopkins Center for House Security Senior Scholar from New York City.
John, they're banned from a few years ago.
Equities, 41.82, of a different time, as you might say. In the bond market, yields are high by a basis point, 158. This is Bloomberg.
With the First Word News, I'm Ruchika Gupta. President Biden is stepping up pandemic assistance to the rest of the world. The U.S. will share its entire supply of AstraZeneca's coronavirus vaccine with other countries. Plus, it's putting together an aid package for India. All this represents a shift for President Biden. He's been focusing on making sure Americans are vaccinated first. Vice President Kamala Harris has pledged an extra $310 million in humanitarian aid to stem a wave of migration from Central America. The money will go to Guatemala, Honduras, and El Salvador. Harris discussed a need for long-term economic growth in a virtual meeting with Guatemala's president. Qatar is ramping up its lobbying efforts in the U.S. It's trying to cultivate a closer relationship with the Biden administration and Congress after being caught off guard in 2017. That's when it faced a Saudi-led boycott in the Persian Gulf. Since January, Qatar has hired 7 prominent firms to do consulting and lobbying work in Washington. And shares of UPS are rising. The package shipper posted first quarter earnings that beat estimates. UPS also reported a 10% increase in revenue per package in the U.S. That's a sign the company is figuring out how to make domestic deliveries more profitable. And shipping containers are falling overboard at the highest level in 70 years. That's sending millions of dollars of cargo sinking to the bottom of the ocean. The accidents are disrupting supply chains for hundreds of retailers and manufacturers, such as Amazon and Tesla. Experts say the pressure to speed up deliveries is raising the chance of making mistakes. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is humanity against the virus, and if the virus
finds a way in India or another country to infect people or to evade the vaccine, then everybody on the planet is at risk from that. So, we really do have many good reasons to fight coronavirus around the world.
A tragedy in India. That was Joshua Sharfstein there, Johns Hopkins Bloomberg School of Public Health Vice Dean. From New York City this morning, good morning, alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Tuesday morning price action looks like this on the S&P, up almost 3 points. We advance almost 0.1% on the S&P 500. Lisa went through the earnings a little bit earlier this morning, just a ton of them through the week. About a third of the S&P. In market cap, in total, it's about $18 trillion worth. Unbelievable. A third of the companies in the S&P reporting, amounting to about 18 trillion in market cap. Elsewhere in the bond market, yields are higher by a basis point, so 158.09, euro dollar 127.5. We come at about 0.1%. Crude 62.33. That is the price action cross asset worldwide. Tom, today here in America, we'll be talking about CDC guidance around wearing masks outdoors for vaccinated individuals. Looking for a little bit of an update and clarification today.
Well said. An update and clarification is needed, not only here, but within the crisis in India, in Brazil, in other places as well, including Tokyo having a real challenge of it. We've had wonderful perspective from Amesh Adalja. He joins us now with Johns Hopkins Center for Health Security. Dr. Adalja, good morning, and thank you again for the repeated briefs. We all are benumbed by whichever one of the cases and death statistic ratios we look at. How do you interpret still elevated cases with the ever lower deaths we see in America? How do you interpret just that simple ratio?
The way I interpret it is that's exactly how the vaccine was supposed to work, because we gave the vaccine initially to high-risk individuals, nursing home residents, and people with comorbid conditions that were in the community. And what we were trying to do was separate cases from their ability to cause serious disease, hospitalization, and death. That's the whole reason we kind of embarked on this whole process, was to try and tame COVID-19. So we're continuing to see that decoupling as more and more of high-risk individuals get vaccinated. So when you go through a hospital, and I worked in a hospital yesterday, it's not the older people that are getting COVID-19. It is younger people who are not yet vaccinated that are where we're seeing cases occur. And those tend to be people who don't require hospitalization, who don't die. Some of them do. Some of them do have severe illness, but that's what we're trying to do, is just remove the ability of the virus to cause the public health emergency in our hospitals that it did. And it's successful so far in the United States, and will continue to be successful as we get more vaccine into people's arms.
Dr. Adalja, what do you make of the fact that, as you say, the people who are hospitalized now are younger, and some people would say even sicker? Is this because of the variants, or is it because just the bulk of people who have not yet been vaccinated are younger, and potentially the people who end up in the hospital have pre-existing conditions?
It's exactly that. It's people who didn't have access to the vaccine but still had some high-risk condition. So yesterday, my last patient was a 47-year-old woman who had morbid obesity, who came in fairly sick from COVID-19, actually gravely sick with COVID-19. And somebody who didn't have access early on, because in Pennsylvania, where I work, first of all, we gave vaccine to nursing home residents, and then high-risk individuals, but in certain age tier groups. So some of those people just didn't get vaccinated. Some of them might be vaccine hesitant, and they still have high risk factors for severe disease. The same thing is likely what's at play at Michigan. So we have to get vaccine into high-risk individuals who happen to be younger, and that's a group who might think that they aren't going to get severe disease because they're younger, and not realize that their high-risk condition is still something that is going to outweigh their age. And that's likely what's happened. There's equivocal evidence whether the variants are more severe. There's some evidence that says yes, some evidence that says no. It's not something that we can say definitively. We know for sure that these variants are more contagious, and we know younger people are more likely to be risk tolerant and not vaccinated. So that variant is finding young people to infect, and it's infecting faster. But again, it's very different walking through a hospital now in most parts of the country than it was just a few months ago, and that's because of the vaccine.
Dr. Adalja, you talk about vaccine hesitancy, and we're expecting to hear from Joe Biden later today, talking about possibly updating the CDC guidelines as to what vaccinated individuals can do. One reason why you're so valuable is because you can dovetail the science with patient psychology. Will this be enough to bring people into the vaccination schedule who might otherwise have been hesitant?
there is a group of the population who is really not going to budge. I've dealt with them all the time. Some of them are colleagues that I work with at the hospital that are healthcare workers, that they just are not going to have it under any circumstances. But there is a group of maybe 20% or 30% of the population that is still deciding, that is on the fence. And one of the things that we need to do is show them how these vaccines, which are safe and effective, are going to change their lives for the better, that things are going to be different once you're vaccinated, that this vaccine is a value to their personal individual lives. And for too long, I think during this vaccine rollout, that wasn't emphasized. So I do think guidance about what vaccinated people can do safely is going to be something that could nudge them in the right direction.
How do we nudge them in the right direction if they don't know the levels of sick and not death that they confront? I see a woeful ignorance about the shades of sickness, knowing that they're not going to die, but they're sick. Have we educated the public on that reality?
We have, but sometimes it goes too far, I think, and then you lose the trust of people, because it is true that the younger you are, the less underlying conditions you have, the less likely you are to need hospitalization, and the less likely you are to die. All of that needs to be part of it, but you have to tell them that, well, you do have certain risk factors. Certain individuals do have certain risk factors for severe disease. You also could be somebody who's left with some long haul symptoms, and that's something you don't want to have anyway. Even if that's something that happens maybe in 5% or less of people, it's still something you want to avoid. So you've got to show people that there are some consequences, disruption that occurs if you get infected with COVID-19, and the best way to prevent that is to become fully vaccinated.
Doctor, great to get your thoughts, your perspective as always. Dr. Amish Adalja there, Johns Hopkins Center for Health Security Senior Scholar. I think Dr. Amish Adalja there just touching on an important point, Tom. Sometimes it can go too far, and what you end up is an irrational fear of this disease as well, and there's been issues with that too.
Yeah, there has been. I mean, I just think that we're almost, John, at a clumsy stage right now where we're seeing these phenomenal decreases in deaths, but the pros have a huge level of angst out there about the people that are sick, and I'm not sure I sense that in the public.
Well, Tom, I want to understand also what the follow-on is as well. Once we start to move further away from this pandemic in this country, and I hope that's soon, and many people, of course, share that hope, do we start to tackle things again like obesity in a bigger way? Or do we treat them as taboo issues that you can't talk about them because somehow you're fat-shaming people? Are we actually going to have that conversation again in this country in a much bigger way?
In America, no. Plain and simple.
But hasn't that been a big problem in this country through this pandemic?
Huge problem.
So why aren't we having a serious conversation about it?
Because it's America.
So we're more comfortable having people fearful on the streets in the open air wearing masks than we are about having that conversation?
Yep.
I think, John...
I just don't know what else to say, but there's a huge differential here on, mostly I'd say, John, it's into food consumption, size of meals. Like me and Lisa Celeste.
Anytime.
Lisa Abramowitz, Tom Keene, Jonathan Ferro. Coming up, Chris Verone, a strategic...
Okay, guys, it's time to play stop on profit for Japanese yen. I'm going to place it at 108.315. Just right here. So if you decided to follow trade, and if you already filled this order, if you hold in position, please keep following until the end. So whatever happened, if you will place stop on profit right now, whatever happened, you will close this trade in profit. Okay, as you can see from previous trade, for example, we traded just about an hour ago euro. You can see we placed stop on profit, 2 pips. We made a profit, and right now the price shoot up to, see, it's right now 120.84. So if some people decided to hold on and not to place stop on profit, they would end up in losses. They would have to find a way to hedge this position. Anyway, on Japanese yen, it's it's stop on profit at 108.315. So all of you, please do so, and I'll speak to you later, okay?
Vaccines and Pfizer and Moderna, and even Russia's vaccine, all of these have efficacy levels above 90%. But the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and death. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
President Joe Biden, nearing 100 days in office, addresses a joint session of Congress. COVID, the economy, the plan forward. Wednesday, 8:30 p.m. on a special edition of Balance of Power on Bloomberg Television and Radio.
Right now, the mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, they party, makeup will bounce back.
We just can't catch up after going through a depressionary bust with this health crisis to suddenly having a runaway bull market.
We know this economic data is great. This is all reopening, fiscal stimulus. Well, how much does behavior change? We're all becoming behavioral scientists.
The real question is, beyond the summer, after we get this reopening-driven boost, how long is this going to sustain itself?
All eyes really are on what constitutes substantial progress right now.
What's this economy look like 6 months, a year down the road? And that's where I think you're going to see this real inflation, and it's going to be more persistent than people are currently pricing in.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Earnings season revving up from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures positive, a little more than 0.1%. Better revenue growth through the year ahead, year on year. Of course, that is the obvious story, Tom. It meets higher costs.
A wall out there. I wish everyone could see this. So the famed Bloomberg headline service is just a wall of earnings coming out at 7:00 at Wall Street time. Just, hundreds and hundreds of headlines, John. And to me, the story is they're managing it. The margins are there. Earnings are there. Maybe there's some forecasts, but it is a real story, corporation to sector, on revenue growth. What is it now and what will it be?
And what will the higher costs do to the margins on some of these companies' balance sheets, Tom? This is the story from Bank of America. I mentioned it in the previous hour. I'll do it again for our radio audience too. The number of mentions of inflation during earnings calls have risen sharply, more than tripling year on year per company so far. The biggest jump in our history since 2004. That's the theme so far of Q1.
Just one of 200 headlines. Archer Daniels Midland, they expect significant EPS growth, another record year in 2021. But then you look at the revenue mix forward, and John, with Verone coming up, this huge mystery of Q3 and Q4.
Q3, Q4, the year ahead and into 22, Lisa. the mystery of that deceleration, that's what we need to start getting our hands around too.
Yeah, and the mystery of just how much some of these consumer staples can pass along these higher costs, these higher input costs. You're talking about the inflation mentions, and it's interesting that Coca-Cola, Chipotle, P&G, Kimberly-Clark, they're all saying they can pass along a lot of these costs. The question is, does that mean that individuals who possibly aren't earning as much in terms of higher wages, whether they stop buying as much? And that speaks to the deceleration that you're talking about.
Going to run through the earnings through the morning. Good morning to you all. Your equity price action this Tuesday looks like this on the S&P 500. Equities up about 5 points, a little more than 1/10% to 41.85 on the S&P 500. In the bond market, yields up a single basis point. Let's call it 158 going into the Fed meeting and decision tomorrow. In the FX market, euro dollar 120.80. We're in about 1/10%, Lisa. No drama, muted price action this Tuesday.
No drama, but definitely to your point, there seems to be a growing consensus about how possibly the more surprises could come out, positive surprises of Europe than the U.S. I'm watching Washington, D.C. Project Get Vaccinated. President Biden will be giving updated guidance potentially from the CDC on what you can do if you've been vaccinated. Maybe you can take off a mask in public. Will there be something more to entice some of the hesitant to get jabbed? Meanwhile, 2:30 p.m., there's going to be a Senate Finance Subcommittee talking about taxes. I'm interested to know about this philosophical debate, this idea that among the Democratic Party, there are some that just believe that taxes should be higher for wealthier individuals, less necessarily to pay for specific plans, versus the Democrats from particularly high-tax states, and I'm thinking in particular Chuck Schumer, pushing back on that and saying, that's not really good enough for us. And also today, after the bell, Microsoft and Alphabet both reporting earnings. One thing, and John, you were talking about how there have been incredible beats, and I've been interested, there was a UBS report showing that that companies have beat earnings by about 25% versus the average of 11%. Just the idea here that the beats have been tremendous. We have not seen the follow through with price action, which makes me question, what are markets following? If it's not faith, if it's not the actual reality, what's driving the price action?
Listen to what the markets are telling you. Tom, that's what we're always told. Let's get to JetBlue just quickly. JetBlue, Tom, expected to reach break even in the third quarter. That's the look ahead from JetBlue, an airline here in America.
The struggle here, I mean, it's very granular, but they're countable. I mean, they're counting bodies and they're counting the revenue and the margins coming in, and they're giving a third quarter vision. You wonder, do you get a third quarter vision from Microsoft?
Joining the transatlantic corridor soon as well, Tom. JetBlue, get into the mix.
Yeah,
New York,
I don't know much about
London,
that.
Boston, London as well, I think.
There's the Mint thing. They do Mint like business class.
Have you tried that? It's actually pretty good, Tom.
Yeah.
It's good.
I mean, I sort of like their planes, like I actually fit in them.
You fit in the plane?
A lot of, you'd be stunned as some of them that, I don't really...
Value add.
Real talk. It's the real talk. I will say the Mint offering, the business class offering at JetBlue is pretty decent. I'll vouch for that.
Very good.
Thank you. Christopher Ryan, Strategic Head of Technical Strategy and Macro Research, joins us now. Chris, good to catch up, sir. Listen to the market. You've become a little bit more cautious in the last couple of weeks, Chris. I think we all took note of that. Why?
I just want to be aware of where we are in the cycle. I feel like we're at that point where this collision between expectation and reality is playing out in real time. And just think about how a market cycle matures. The first 6, 8, 10, 12 months off of a low, it is remarkably easy to beat very low expectations. As that cycle matures, I think the bar gets higher. I think we see that with some of the sentiment data. I think, as Lisa points out, some of the responses to earnings might not have been as robust as one would expect, given the strength. And I think ultimately what we have to figure out here is, are we heading into a period of peak data? And peak data historically has been met with corrections. I'm thinking about 1984. You were 13, 14 months off the low. You got some of the best data of the cycle, and you went nowhere for 10 months. I'm thinking about 2004. You get PMIs in the 60s, and you had a good correction the first 6 months of 04. Think about 2010. You were 13, 14 months off the 2009 low, and the market stalled with the best data of that cycle. So I just want to be a little bit respectful of where we are. There's really not much in the charts yet to support this view. What we're doing here is building up history and saying, okay, what do we need to be mindful of over the next couple weeks and months?
Chris, that's right where I wanted to go, which is what is in the charts. When you look at individual charts, when you look at sectors, when you look away from equities, what do your charts guesstimate about the inflation fear that's trenchant right now? It's just knee deep.
You know, Tom, I think the sector right now that is telling the most interesting story is consumer staples. I think staples are help answering three questions. So yesterday, staples made fresh relative lows versus the S&P. So staples are at their lowest relative point versus the S&P we've seen at any point over the last several years. To us, that answers three questions. Number one, it says we're probably not late cycle. Staples tend to outperform late cycle. They're not doing that here. Secondly, I think they argue that some of the price and inflation pressures are stickier than the Fed tells us that they are, right? Staples are very sensitive to food input costs. We've seen what a lot of the food stocks have done over the last several weeks here. They rolled right back over. And then third, if bond yields were going lower, wouldn't staples be stronger? So I think the weakness, the relative weakness in staples, the relative weakness in utilities suggests that bond yields probably don't go a ton lower from here. So the staples for us are telling a lot of very different, interesting stories.
Chris, the idea that bond yields might not go much lower from here, does that mean that bond yields will go much higher from here because of those inflationary pressures that perhaps, as you say, might be trending in a stickier and more significant way than the Fed is considering?
You know, I think we're pausing yields basically on sentiment and flows. If you look at some of the sentiment work in the bond market, you know, 3, 4, 5 weeks ago, you got to a point where just everyone was a bond bear. And I think there needs to be a sentiment response from that. And we've seen that over the last month. But I would turn your attention to some other areas of the world, like German bond yields really have not gone down. I think before you were talking about the areas of the world where there's room for surprise, the fact that German yields have not gone lower, I think tells us the ability to surprise in Europe is probably easier than it is to surprise here.
So add to that, Chris, have you got a conviction long in Europe right now?
Yeah, I think these European autos, which basically spent the last 5 or 6 years in purgatory, have all turned. There are leadership groups within Europe. I think the industrials within Europe. But look at the materials. All these big global material stocks, many of which are found in Europe, are breaking out of these big bases. Isn't that screaming weaker U.S. dollar to us here as well? You had this tepid rally in dollar over the first 3 months of the year. Dollar has rolled back over as these big global bellwether material stocks have broken out. I think this is all telling us the same story.
Chris, always good to see you, mate. Chris Verone, Strategic Head of Technical Strategy and Macro Research. Autos in Europe up almost 21% year to date so far, Tom. What a run
it's been a run.
Had.
You know, I looked at a lot of log charts today, John, where slope matters, and you're absolutely right. The leg up here, and we're just addicted to it. I mean, you know, there was a real measured view in January. It was wrong. It has been, as you say, what a run. And the answer is, can it go forever? And the answer is, we heard from Mr. Verone, no, pauses are in order and healthy.
You know what I've struggled with? If you look at the economic data, of course, the pickup hasn't been synchronized. Q1 was America's quarter. If you look at the price action, a lot of that has synced up. Europe, US, Lisa. The banks on both sides of the Atlantic have done well. It's not as if we're coming into Q2 with European banks severely underperforming US banks off the back of better growth in America versus worse growth in Europe. I understand the bar for relative surprises here for Europe. I've made that argument. We've been pushing that through the FX channel. On the equity side, I think it's a little bit more complex. It's more nuanced, more difficult.
Yeah, the question is, are people perhaps looking past some of those risks, the differentiation, and look in search for the idea of a discount in a very highly priced world? I do want to say something that was really interesting that I read from Societe Generale Steve Englander this morning on the Euro call that Chris Verone was just talking about. He said that the U.S. trade deficit may have widened dramatically in March and that this could actually weaken the dollar. The idea here that all of that money that the U.S. government put in the hands of individuals went to buying stuff that helped the rest of the world, that caused the imports to way outweigh the exports from the United States.
That thud you just heard was in Singapore, Lisa. Mr. Englander, who's been at 42 firms in the last 44 years, holds court at Standard Charter. Not SocGen, but that's okay.
It's okay.
We folks, what Lisa just did there. What Lisa just did there. I can't keep track of where anybody is, John.
I agree.
mean, it's totally
it's tough. Well, it's particularly tough in foreign exchange sometimes too, Tom.
You don't even know, like, Jordan. Where's Jordan Rochester this week?
Nomura.
Okay, thank you.
Still, I believe. Coming up at 8 a.m.
Some of these
John
people have
Rochester's
been at
probably
like
listening to this
3
right now,
firms.
thinking, I hope so.
3 firms in the last 6 months, and you're like, we're in our years to Riley. Where are they?
James Bevan is still at CCLA. He's still the Chief Investment Officer, and he'll join us in the next hour. Equities up 4
Good
points
morning,
on the
Mr.
S&P.
Englander.
We advance a tenth of 1%. Euro dollar 120.81. Your bond market, your yield higher by a basis point to 157.92. From New York City this morning, good morning. Tom is with Bloomberg still, I can confirm. This is also Bloomberg.
With the First Word News, I'm Rishika Gupta. President Biden's proposal to boost the capital gains tax would hit individuals earning $1 million and married couples jointly earning the same amount. The president is set to unveil his plan tomorrow. It would almost double the capital gains rate for some taxpayers. Meanwhile, President Biden is expected to sign an executive order today that would raise the minimum wage for federal contractors to $15 an hour. It's currently $10.95. The new $15 wage would start next January. The latest U.S. Census figures are good news for Republicans. Texas will gain 2 seats in the House of Representatives under the new population numbers. Meanwhile, states in the Northeast and Midwest will lose 7 seats in a shift of political clout to Republican strongholds. And California will lose a seat for the first time ever. General Electric burned more cash than expected in the first quarter. That's crimped CEO Larry Koch's turnaround push after signs of improvement. GE's earnings did beat estimates, but still Koch sees a difficult environment for the crown jewel of GE's industrial business, that is GE Aviation. U.S. companies face soaring bills for all kinds of materials that they need to do business, and rising demand is helping them pass on those costs to customers. In earnings calls, executives from businesses ranging from Chipotle to appliance maker Whirlpool have outlined price hikes. Their comments back up the data that show inflationary pressures building in the economy. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center.
to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America.
There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
We have been reminded that the status quo is not nearly good enough, and that innovation is indeed the path forward. For our part, the United States will work to end the pandemic with our partners and allies. We will invest in our health security at home and globally.
That was Vice President Kamala Harris addressing members of the UN from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Tuesday morning shaping up as follows in the equity market on the S&P 500. Equity futures up a little more than 0.1%, positive 5 points on the S&P. We have $18 trillion worth of earnings this week on the S&P 500, an unreal amount. Apple coming up tomorrow, Amazon on Thursday. Into the bond market where yields are higher by a basis point to 157.92. Euro dollar basically unchanged now. The euro against the US dollar 120.81, and crude up 0.6%. WTI $62.30. Racing through the earnings for you. This one just for you, Tom. Crocs full year revenue growth to be between 40 and 50%
when you
year.
When you and I had lunch the other day in Soho, you had on those classic Neo Puff Crocs.
Oh, I love them.
They were great. The yellow ones that you
have. I had
have.
no idea that people actually wore these seriously, but apparently they do. Full year revenue growth to be between 40 and 50% year over year.
And I bring this up, John, because it's sort of, to me, anecdotal. I mean, it's like company to company, and we're all focused on Amazon and all that, but each company has a story about how they're doing in this horrific natural disaster.
Well, they're doing pretty well, apparently, Lisa, raising 2021 guidance for the year.
The Crocs story is that everyone's home and they prize comfort over all else, and so Crocs are surging.
And the outlook's better too.
That sounds like a woman speaking with authority
there. This trend continues.
Well, I mean,
this trend continues. People have just given up.
People have given up. That's how you interpret it. Yeah, they've given into a new life.
Jack Fitzpatrick joins us right now. He is certain there isn't a Republican that would be called dead in Crocs, and he joins us from Washington this morning. Jack, the president will speak, and it will be a most interesting speech to the middle of both parties. How did those middle parties shift with the census announcements yesterday? They wake up with a new America for the next 10 years. What's it mean for moderate Democrats? What's it mean for moderate Republicans?
Well, in a practical sense, in the near future, some members are going to be worried about getting redistricted out of their seats. And it's unclear exactly who, but the ones in the states that are losing seats, Michigan, Illinois, Minnesota, New York, Pennsylvania, California, Alabama, are they're potentially in trouble. That's a political minefield there. More broadly, as we look to 2024, a lot of this is a shrinking Rust Belt, and as you saw, growth in Texas and sort of more the Sun Belt other than California.
Okay, traders, position closed on Japanese yen, as you can see, at 108.315. We collected right now 200 pounds in profit. How much did you make? You can send us your reply. How much broker pays you per pip? Are you trading on margin? Let us know. In our case, we have 100 pounds per pip. You can have another amount, 30 pounds, 15 pounds, 50 pounds. Because we trade banks' money, hedge funds' money, we have quite big account. In your case, you can have smaller. At the end of the day, you made a profit by day trading. Okay, stay safe, and let's look for other opportunities to make a profit from trading Forex. Okay, I'll speak to you later. Stay safe.
and the lessons that Democrats learned in Georgia. For example, Georgia isn't gaining a seat, but that's the kind of state that is increasing its clout in the long term.
Jack, how do capital gains taxes appeal to Republican voters, in particular those who voted for President Trump?
The capital gains tax may not appeal to Republican voters, but that is one of these issues, along with the increase in the corporate tax rate that Biden is pushing, where he's very aligned with, say, the Bernie Sanders side of things. And it is a sort of populist approach. It's interesting that he's played it both ways. He's pitched that as a tax policy on its own, but also as a pay for this next round of legislation. So he's tying that rhetorically to free community college, childcare, and that kind of thing.
Jack, can you lift the lid just a little bit for us up here in New York on what is happening down in Washington with the lobbying effort from big tech companies, the people who are affected by this discussion that we're having right now? What does that look like at the moment?
Well, in terms of lobbying, I mean, a lot of this is happening out in the open because there's so much Republican opposition to what Democrats want to do on taxes. So even lifting the lid, it's very, very clear Republicans are outright opposed to not only the capital gains issue, but a lot of the corporate tax proposals by Biden that he wanted to do sooner in this next bill, the infrastructure bill. There may be some middle ground, but really clearly it hasn't even taken a lot of lobbying to get very significant opposition to these proposals, and anything that's going to become law at this point, unless they ram it through in a partisan way, is going to have to be very, very watered down.
Jack, good to catch up, as always, down in Washington. Jack Fitzpatrick there, Bloomberg government reporter. I want to turn to some earnings this morning as well. We've got a lot to get through. UPS up by almost 7% in early trading. Tom, it was a big beat, up by 6.93% in pre-market trading right now.
We're making jokes about it, Crocs and all that, but this is really serious. This is a real litmus test, John, for the entire nation. And if I'm at Microsoft, and particularly if I'm at Amazon, the UPS story is great news.
Amazon on Thursday, Apple coming up on Wednesday, Lisa.
Yeah, sales of UPS climbed 27%. Not entirely surprising. I guess the key question with UPS is exactly the labor cost, wage dynamics here, given the fact that they have to hire enough people. I mean, they are dealing with labor shortages along with a lot of other companies, John.
Dreaming of reopening is easier than actually doing it. The words of Mike Wilson over at Morgan Stanley. This is going to affect different companies differently. Tom, just to state the obvious, this is not going to be a broad-based story. I think it's going to be really interesting to see who can meet that bigger demand.
On a unit basis, Lisa just nailed it, John. It is about hiring the marginal unit worker.
Yep.
That's going to be, right now where I sit, that is the theme for the next 200 days. Where do you find the next worker?
And labor costs are going where, Lisa? They're going up.
Yeah, and really, I mean, they're being spurred up also by this $15 minimum wage proposal by President Biden this morning, an executive order for contractors with the federal government. You do wonder how much staying power this has. Does this count as, should I say it, transitory?
Transitory.
Where's Tom? Is he drinking?
You think the news conference is interesting tomorrow?
Yeah,
with Chair Powell? I do too.
I think it'll be fascinating.
I think it could be interesting. I don't think policy changes in any way, shape or form. I just think the conversation's shifting already, and they've got to respond to that. It's a big chug you're having there, Tom.
Transitory.
Coming up, Vasilius Janakis, Bank Lombardo DA head of FX strategy.
And I'm trying Cholula.
How's that working out, Tom?
With the Worcestershire sauce, it doesn't really work.
Worcester sauce, Tom.
The Leicester sauce.
Worcester.
Value add.
God, how many years have we worked together?
They didn't get relegated. Watford, Worcestershire is going to be a great game.
From New York, this is Bloomberg.
is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Live on TV and radio for our audience worldwide. Here's the price action on the S&P 500, the Nasdaq, the Russell. We advanced by 4 points, up a little more than 0.1% across the board here on the Nasdaq and on the Russell too. We're up just a little bit. Let's flip things forward into the bond market, switch on the board. 2s, 10s and 30s. Yields are higher by a couple of basis points at the long end curve, just a little bit steeper. 226 on 30s, about 158 on 10s. I'll keep moving forward quickly. Let's finish on this. Copper. Lisa brought this up yesterday. Now the highest since March 2011 and pushing towards 10K here.
LME 10,000.
On the London Metal Exchange. Thank you, Tom.
Yes.
We're up by about 1.5% intraday.
For our American audience, bear with us.
We'll get there in a moment. The miners in Europe up more than 20% on the Stock 600. That appetite for copper has come back again after topping out in the middle of February. We take out that high and we push forward to 10K. You want to talk about the LME a little bit, Tom?
Please,
move
please.
things forward?
Please, I insist.
The heritage of the London Metal Exchange.
You know, I'm looking at London. Oh, I'm looking at London LME Palladium.
And what do you see?
Moonshot, hyperbolic.
Shiny metal.
Thank you. Copper, 98.92, just unbelievable numbers. We'll touch on that a little bit more a little bit later. The earnings today, tomorrow, Thursday, all piling up. Here's Romain Bostic.
Yeah, a fire hose of earnings this morning. Of course, let's start with travel, housing, and I guess e-commerce here. JetBlue Airways did actually report here. Interesting, demand is picking up, and the company seems pretty bullish about that demand really persisting through the summer. The problem is those costs are rising. Labor costs are rising, as well as those fuel costs, and the company's saying that's actually going to put a crimp, at least in profitability going forward. There's also a little bit of concern here about revenue on a year-over-year basis. The forecast is still for a drop in revenue from the previous year here, though still an improvement here from the pandemic levels here. Pulte Group actually reporting earnings, and they were pretty much knocked it out of the park here. Sales for homes continues to go higher. Pricing power continues to work in their favor, but investors may be a little bit concerned here about the persistence of some of this. Remember, you're talking about 19% revenue growth in the first quarter. That was about what the street was expecting, but they're still looking for 20+% growth for the next 3 quarters, and I think some investors are now starting to wonder whether that's going to be met. UPS also having a great quarter as well. Interesting number here was what they made on international revenue per piece. This actually rose about 12%, and this is a huge metric because remember, that actually dropped in the previous year-over-year comparison, primarily because of the pandemic. So a little bit of a return to normalcy here. After the bell, another deluge of earnings going to hit as well. Keep an eye on Microsoft. This is going to be a huge story. Gross margin expectations for this company, 68%. That's what the street is looking for on this company. A company that right now that has just shy of a $2 trillion valuation. Alphabet also reporting we've already gotten a peek at some of that digital ad spending. It appears that Google probably is going to continue that streak that we've seen for some time. So expectations higher for both of those companies. Expectations not all that high for Starbucks here. They've been really hurt by coffee prices. Arabica beans right now at a 3-year high.
Romain, did their story shift, their ballet shift this afternoon on the close because of the Apple announcement yesterday? Does Microsoft got to come out and, talk about state funding and job formation and all that?
I mean, well, I don't think investors care as much. The other problem, though, is Microsoft doesn't really need to. I mean, the thing with the difference between Apple and Microsoft is Microsoft, to a large extent, is still a growth company. Apple really can't claim that anymore. It's always been, or at least for the last few years, it's been much more of a value play, and you have to give investors a little bit something more than just, that 5 to 6% juice that they're getting every quarter.
Is that it?
I mean, there's tons of other earnings, Crocs earnings, ADM.
Crocs, please, Romain. Crocs, please.
They're doing well. Justin Bieber's on board, the Bieber bump. I know you've got a few pairs in your closet there, Tom.
I do.
Keep rocking them. Yeah.
Justin Bieber wears Crocs, does he?
He was a big endorser of them.
I did not know
this
that.
has been a huge strategy for Crocs in all seriousness.
I can't
they
say
get
I've
the
been
celebrity endorsements, John.
You
could be next.
Following it.
He is. No, John's got the yellow Neo Puffs. They look great. Okay, Romain,
Is this
thank
what
you so
wealthy
much.
people embarrassed of their wealth do? They wear Crocs. Is that what that is?
Yeah, that is. It's like if the Beebs is doing it, John, you got to get on board.
Okay. It's
Right now in foreign exchange, Romain, thank you so much. Very importantly,
Thanks,
to close, must watch, must listen this evening. They do the 5 anchor thing. They're right at the close, very informative with the earnings coming out. Right now, Vasilio Giannakis with us. Bank Lombard ODA as we look at the foreign exchange. Vasilius, I've got to go right to the dollar and the catalyst for the when of dollar weakness. What will drive dollar, say DXY, finally below 90?
Well, I think it's going to be when we get further confirmation that the vaccination rollout in the European Union is gathering pace. I think what we're getting right now is that we are in a really good global scenario where you have a big global growth and trade upswing. You have commodity prices rising because pent-up demand is rising. There are some question marks, one about the pace of potential future yield increases, and secondly about how the vaccination rollout in the EU is going to pan out, which is likely to affect the growth outlook, especially in H2. I think on both fronts, the view is that the pace of yield increases is going to be normalized, so it's going to be consistent with the fact that global growth is picking up, but it's not going to be abrupt as it's been in late February and March. And recently, over the past 2-3 weeks, we've seen it pick up the first derivative of the vaccination rollout in the EU, picking up some pace, albeit from very low levels. But nonetheless, I think a lot of that has already been in the price. So I think from a fundamental medium-term view, I think the dollar goes lower from here, with the only caveat of the May seasonality. There is a very strong element of May seasonality, which is the dollar higher.
Is there going to be a lot of jawboning about stronger euro? Do you anticipate that we will see nations saying enough of this weak dollar strategy, or is that an ancient idea?
Look, it's something that, we've been talking a lot about recently. Everyone is really focused and obsessed about euro-dollar. But let's not forget that what's really relevant for Eurozone inflation is the trade-weighted euro. This is what really matters in terms of the pass-through or not of prices into domestic inflation. And in that respect, Euro-China has the biggest weight. Now, to the extent that you're talking about a broad-based, generalized dollar weakness, euro-dollar upside is not going to translate into euro-China upside, more likely potentially euro-China downside, because the renminbi has plenty of appreciation to go to. So in that respect, I think this will keep the trade-weighted euro in check, and I very much doubt that we're going to get a collective, synchronized by all governing council members of the ECB noises about the level of the euro.
Vasilios, just pick up on that. Euro-China down on the year, with you there, but there's a clear slowdown, or at least a maturing of the recovery going on in China. The credit impulse is rolling over in China right now. What's going to drive that additional renminbi strength?
Well, I think there are a lot of factors. First of all, I think it's quite clear that the PBOC is in a very slow tightening mode, and indeed we expect some 30 basis points of tightening towards the end of the year or beginning of the next. Secondly, the other important element is that you keep on seeing portfolio flows going into China. These are flows largely because of the gradual process of capital account liberalization, but also as well of the fact that Chinese bonds are being included into bond indices, and this thing has not been exhausted. And what's interesting is that a lot of the flows that come into China on the corporate and the retail sector have not actually been converting it to renminbi already. As a matter of fact, over the past 8 months, a large chunk of domestic players have actually been hoarding a lot of dollars. They have accumulated about 180 billion of dollars, which is quite unusual. And we expect that this thing is going to start unwinding, meaning that domestic players are going to start converting these dollars into the renminbi, pretty much reminiscent of what happened, I think it was about 4 or 5 years ago, back into 2016, and this is going to lead to another leg lower into dollar China and potentially other renminbi crosses.
Vasilios, when does the PBOC, the People's Bank of China, get involved to suppress the renminbi's rise? We saw it peak out at, I believe, 7.2 per the dollar. When does the PBOC get back involved, given the fact that we're all the way back down to 6.479?
Well, I think that the PBOC is one of these central banks where they learn by doing, and they try to avoid mistakes from the past. I refer to what happened back in 2015 of the devaluation and everything. Basically, my main point is that I think right now they have shifted into a regime in which you have a controlled appreciation. And I think they're very happy with it, and I think they're pretty comfortable with the renminbi going higher in a normalized fashion. Now, if you look at the renminbi, the CFTS basket, typically you tend to think of the PBOC having a range between 92 and 98. However, if that rebounding global growth rate continues, the fact that China has not lost a share in export competitiveness, then I don't think that the PBOC is going to have any problem seeing the trade-weighted renminbi, the version of the CFTS basket, breaking above 98.
Vasilios, we've got to leave it there. It's always good to catch up, buddy. Vasilios Giannakis there, Bank Lombard Odier, head of FX strategy. On the ECB and tolerating a stronger currency, Tom, I wonder, in a different kind of question, whether they will tolerate the high yields that could lead to a stronger currency. Will they see it as consistent with a brighter outlook in the same way the Federal Reserve did more recently? And I think many people have their doubts about that.
The history is they will jawbone. The question is when. John, we heard 6 months, a year ago, it'd be 130, then it was 128, then it's 125. What do you think, John? Up 3 figures here and they start, yapping
Maybe.
about
We've
it?
seen it before, Tom. I think the thing that's going against the ECB right now is they don't seem to be on the same page on anything at the moment.
Yeah.
The governing council is starting to split in a way that we have done before, at least according to several reports, and that could get dicey in the months to come.
The microcosm of earnings, John, I want to go away from Amazon, Microsoft, Alphabet as well. Hubbell, Shelton, Connecticut. John, they make 130,000 electrical parts. You know what? They got revenue growth, high single digit. They're minting money, and they're raising their dividend. They're up 90% off the bottom.
Raising their full-year earnings forecast too, Tom. The guidance is better as well. That's the story in America right now. A better outlook. That's been the story of the last 6 months. Equities up 3-4 points on the S&P. This is Bloomberg.
With the First Word News, I'm Rich Gupta. President Biden is stepping up pandemic assistance to the rest of the world. The U.S. will share its entire supply of AstraZeneca's coronavirus vaccine with other countries. Plus, it's putting together an aid package for India. All this represents a shift for President Biden. He's been focusing on making sure Americans are vaccinated first. And President Biden is staking a claim on economic issues ahead of the 2022 midterm elections. According to his advisors, the president's infrastructure and family support plans are an appeal to the discontented white voters who put Donald Trump in office. He's also targeting independent suburban women. Polls show there is some Republican support for the Biden proposals. Qatar is ramping up its lobbying efforts in the U.S. It's trying to cultivate a closer relationship with the Biden administration and Congress after being caught off guard in 2017. That's when it faced a Saudi-led boycott in the Persian Gulf. Since January, Qatar has hired 7 prominent firms to do consulting and lobbying work in Washington. Eli Lilly has cut its forecast for annual earnings per share. That's after the federal government cancelled an order for the company's coronavirus antibody. Instead, the agreement now focuses on Lilly's combination treatment. Earnings and revenue both missed estimates. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rich Gupta. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Wednesday, the Fed decides. The Fed is on hold waiting on inflation. But for how long? Coverage begins 2 p.m. on Bloomberg Television.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Decompose the decline in rates. It's all been led by real rates. So I think the markets finally heard the Fed, that the Fed is going to be extremely patient, that they're going to see actual data, not just forecasted data. And so therefore, with the Fed controlling the front end, not even talking about tapering, I think that limits how much rates can rise.
It's almost tedious, isn't it? Most people just agree with each other on the Federal Reserve going into tomorrow. Priya Misra, TD Securities Global Head of Rate Strategy from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Equity futures up 3 on the S&P 500. We advanced not even 1/10%. Yields are up a couple of basis points on a 10-year to 158.27. Euro dollar totally unchanged. Euro dollar 120.85. That's the story right now across asset. Let's get straight out to Zurich, Switzerland. UBS taking another hit from Archegos. I say another hit because it's been bank after bank taking hits, Tom. The total hits now more than $10 billion from that one investment firm. Unreal.
It is a whale, but a different whale than what we saw over 10 years ago. Jonathan Tice joins Bloomberg Intelligence, senior analyst for beleaguered European banks. Jonathan, it's 300 yards between UBS's headquarters and Credit Suisse headquarters, up and away from the lake. Great. What's the difference right now between UBS and Credit Suisse?
Well, obviously, UBS has a slightly smaller wound to lick from the Archegos fallout. And with the new CEO at the helm, clearly he has the sort of fresh set of eyes perspective. And I think, for example, prime brokerage, UBS are probably likely to retrench far less than, say, Credit Suisse. But clearly both of them somewhat blindsided by what happened with Archegos.
Well, clearly investors too, Jonathan, because no one was told how big it was. We were just told it wasn't material. Can you help us understand that a little bit more? When a bank says from now on that it's not material, what it actually means?
Well, I mean, bear in mind, I think that sell side was probably looking at low hundreds of millions of dollars. So, yes, it's another 300 or 400 million, but in the grand scheme of things, over a year's earnings, not huge. It is somewhat surprising that they weren't in a position to give a much tighter number, but I guess because all the attention was focused on Credit Suisse at the time, maybe they thought that they wouldn't have to worry and perhaps things could look slightly different levels. And it's not like we haven't seen this in the past, and things have been revised upwards, but we've got a very accurate figure for 2Q. So I think the share's down 3%, with some very strong wealth management and private banking, etc. flows. Just reflects a little bit of disappointment, but nothing more, because we should be able to draw a line under this particular incident now.
Are there potential risk management issues, though, that come up, especially due to the fact that they didn't think that it was material to mention this, and the likes of Deutsche Bank, set to report later this week, evidently missed out on this risk?
Well, it looks like, if you look at the news stories, Deutsche did actually manage to exit the positions pretty swiftly and far more efficiently. So I suspect that everybody had a bit of this, and it was a question of who was most aware. So risk management and UBS, as I say, they've got a new guy at the helm. No doubt he will be having a look at this too, thinking, how did this happen? Why wasn't I told immediately? But he was quite clear in the interview earlier that he's not looking to aggressively retrench from prime brokerage.
We're talking about the Archegos hit, and there were some positive wins here, particularly when it came to wealth management. However, still a lot of cost pressures, and I see that HSBC is cutting office space by 20% this year and having business travel. Are European banks only playing a game of cost cutting at this point?
Well, actually, I think European banks are still somewhat behind the curve for cost cutting. I mean, bear in mind that everything was put on hold last year as the pandemic hit. And if you look at a lot of European banks' retail footprints, think Italy, think Spain, think Germany, these are some of the most overbanked countries in the world. So you've still got an enormous retail property footprint. There's a lot more to come. We've seen BBVA and some of the other Spanish announce very large headcount reductions over the past couple of months, and we are going to see more. So no, I think there's a lot more to come.
Jonathan Tice, you are expert at the revenue compare and contrast. I'm always shocked at how small the Swiss banks are on a revenue basis relative to the U.S. big banks. What is their transactions and combinations future? What does UBS do? What does Credit Suisse do?
Well, I mean, they've both gone reasonably aggressively down the private banking wealth management route. If you think about UBS and its retrenchment out of fixed income, which is very similar to what we saw with Deutsche and equities, they've become far more selective in the businesses that they're in. So I think when you think from a sort of non-investment banking, and actually even there, equities is reasonably big for, say, UBS, they certainly punch above their weight, and I think they're sort of top 10 globally. You forget, I think, quite how big the US banks continue to become as Europe spent a decade in turmoil.
John, before you run, how's this for a stat? It comes from Shaheen Nesirapur here at Bloomberg News. Coming from the Fed data, Tom, total loans and leases fell to a record low as a share of deposits. Now, we talked about that subdued loan demand in the first quarter. Does that continue, Jonathan Tice, into Q2, Q3?
Yeah, well, I mean, we know that the behaviour of the corporates and retail last year has ramped up deposits, and credit cards and loan facilities have been paid down. So that will continue to be a function of how quickly things rebound. But if you look at HSBC in the UK today, actually some pretty good numbers. So it'll take a while, but I would expect normalisation to happen over the next 2 to 3 quarters.
Jonathan Tice of Bloomberg Intelligence, thank you, sir. Tom Keene, a story as old as time, the difference between what is happening with the European banks and the American banks. And didn't Archegos just capture that almost perfectly over the last month?
Well, it was an accident along the way, and you're right, John, to bring it up and the 10 billion number and all that. But to me, it just comes up to how do you compete away from this easy crutch that we see right now, which is everyone's going into wealth management. John, who is not going into wealth management?
Tom, the issue, though, that you've brought up again and again repeatedly over the last couple of weeks, and it's for you to say yourself, but from what I see, from what I hear from you, is that you think this is an attitude problem.
Yeah, absolutely. I 100%. Sorry, it's cultural, it's attitude. They're comfortable doing what they're doing, and they're bathing in their comfort, and you get into trouble.
So when does that change? And why hasn't that changed? David Herro, who's had that position over at Credit Suisse, has been waiting for that culture change for a long time. Tidjane Thiam couldn't get it done.
We've had the conversations at Davos, people looking for a change, whether it's cross-border or within nations, and it just hasn't happened. I go back to Fortis long ago and far away. There's not enough Fortises going on.
Lisa, final word?
There is a tension here. How do you make money? How do you take the risk you need to take in a negative yielding environment, which is all of Europe, in order to do so without necessarily suffering the consequences? And this tension keeps getting borne out and will keep doing so if they want to just make more money.
I remember a line from President Draghi many years ago when he said rates had to be low now so they could be higher in the future. I think rates are lower now than they were then.
There you
go. They're not going up for a long time. James Bevan of CCLA will be joining us in just a moment. It's coming up on Friday at 1 p.m. Eastern.
Everyone will be wearing Crocs.
I'm trying to start recording that. I'd like to record that as we get to the summer months at, I don't know, 10:30 Eastern.
I don't know.
Would that work?
Maybe I should try Crocs.
Yeah, I'd love that too, Tom. This is Bloomberg.
one of the interesting features about this illness is that if you look at it, the people who develop these long-haul symptoms are often not the individuals who are hospitalized and were sick and on a ventilator and stuff like that. These are individuals who actually, most often, they never went to the hospital. They had a relatively mild illness in the acute phase, and they recovered from it. If you were in the hospital, means you probably mounted a very strong immune response, okay? You recovered from the illness, you probably got rid of the virus. If you never mount a strong enough immune response, then what happens is you may have mild symptoms. You thought, oh, I escaped this. But in reality, you never got rid of the virus. So you get this chronic immune activation that persists in these individuals. But it's never good enough to get rid of it because they never got rid of it in the first place. But it's enough to start causing collateral damage. And what the virus does is it inhibits certain types of immune responses. It's a drain on society at every single level. I mean, it affects women more than men. It affects people in their average age is 40. That's the most productive years of your life. And so you can see that the impact, worldwide impact of this is unbelievable. Economic toll, the psychological toll, every aspect of society is going to touch.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Can't catch up after going through a depressionary bust with this health crisis to suddenly having a runaway bull market.
We know this economic data is great. This is all reopening, fiscal stimulus. Well, how much does behavior change? We're all becoming behavioral scientists.
Ultimately, what we have to figure out here is, are we heading into a period of peak data? And peak data historically has been met with corrections.
All eyes really are on what constitutes substantial progress right now.
The good news is long-term, big picture, the Fed has a long track record of controlling inflation, but it could come at a cost.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast. Bloomberg Radio, good morning. Bloomberg Television, good morning. In the heart of earnings season, more earnings at 7, now further earnings at 8. But, John, we all await Microsoft today to see what big technology does across this nation.
Then on to Apple tomorrow, then on to Amazon this coming Thursday, and that's where the earnings growth has been for a long, long time. Tom, the story's changed, though. It's about the year-on-year base effects, and the base effects for the big tech players, a little bit more complex than, say, the base effects for some of the cyclical companies. But the story for me has been repeated by Morgan Stanley. Demand is good. Can we meet it with supply? Can we execute? And it's the execution risk that gets a little bit more interesting in the weeks to come as these numbers pour in.
And what's so important about these numbers, John, is what we saw with Apple yesterday. It's two Americas. There's this America almost guilty from their prosperity, and another America in this natural disaster flat on its back.
Political risk around wages, political risk risk around the taxes you pay. And these companies want to put themselves out front as part of the solution. Part of the solution before anyone concludes they're part of the problem and does something about it. I think Washington, D.C., parts of it, Tom, have already made their mind up that they're part of the problem and they want to do something about it. And the Federal Reserve is doing its bit to keep things loose for a long, long time, while this government, this administration is going to start doing its bit a whole lot more too.
And the president with the speech, and Jerome Powell with the speech at his press conference tomorrow. Lisa, I think one of the observations you've had in this stew of politics is simply the labor shortage that is here right now. We're hearing about that in earnings releases.
And how does that translate into persistent wage growth, right? I mean, basically people say it's, here, this is for you, Tom, transitory. And they've continued to say that with respect to all of the inflationary pressures. But going forward, is this going to be transitory, especially if there isn't a change in the immigration policy, John? That is for you, in order to get people here to work for some of these companies that are seeing labor shortages.
Any excuse to let him have another drink. Any excuse. I mean, it's the issue right now, and I'm with you, Lisa. I really am. Is it transitory? Is it persistent? How persistent will it be? You like that?
Just
gonna keep
it
going.
yeah.
Is it transitory? Is it persistent? I love doing this. But that is the issue right now for the Federal Reserve too. Can we meet that demand with supply? And to what degree has the entitlement spending, the fiscal effort, held back that supply, just choked things off a little bit? And when do we start to bite into that in the months to come too?
And then the other thing is to have the courage to be in this. Let's get through the data. We've got a wonderful guest to begin here on the courage to be in the equity market, given all of the transitory themes we speak of. John, help me out here. I've got green on the screen. I mean, I'm sorry, it's an equity market with a bid.
Yeah, equity's doing okay, Tom. Up almost 1/10%. The S&P 41.83.
VIX under 17.
By about a basis point, 157.92 on 10s. And euro-dollar just totally unchanged, 120.86. And I think Lisa mentioned something additionally this morning. In addition to all the great things that Lisa talks about, is just the lack of response in this equity market to some of the big beats so far that we've seen. And I can say safely that UPS isn't one of those names this morning, which has delivered some really nice numbers and is absolutely charging on, Tom, higher in the free market.
John, a story for May. I want to get to it right now. That's what we do at Bloomberg Surveillance, and you see it in the London Metals Exchange, the LME. John and I adore it. I particularly adore their annual convention that they have in London at the Dorchester. And John, I'm sorry, copper 10,000 is cause for celebration.
The highest since March 2011 for copper. That story continues. Higher prices, the miners are doing better off it, a better demand outlook, and tighter supply may be the issue there too. I want to bring in James Bevan of CCLA,
Please
the
drag
Chief
him in.
Investment Officer. James, you like the miners right now in Europe?
John, I absolutely do. I think there are some great quality opportunities. And what I would observe, interestingly, is that the ratio between the copper price and the gold price suggests to me that 10-year US Treasury yield should now be at around 2.5%. Now, we know it's not there, principally because Japanese investors have been buying, facing almost zero yields within their own market. But I would have a side bet with you that we will see the 10-year yield at 2% by the end of the calendar year. And that's a relatively big move, given that we only got through 1% on the first trading day of the current calendar year.
Is that a move that looks like the move we saw in Q1, a move that's accompanied by better banks, better bank stock performance, better cyclical performance, better small cap performance? Do the cyclicals perform in line with that move higher on 2s, on 10s, 2-2?
Johnny, I don't think they do. I think the banks are going to have a very difficult time. I would observe that the banks are now awash with overnight deposits. That's extremely bad news. The banks seeking to lend on. What they want are time deposits. They want long-term deposits. They don't want all the hot money. And I think, therefore, that the banks have had their day in the sun. I would only, in the case of the States, want to be invested in JP Morgan and Bank of America, both of which I think have excellent opportunity to cut costs to support long-term returns. The middle ranking banks, however, are going to really struggle. And that, I would say, is going to be one of the challenges for cyclicals writ large. They discount a lot of bad news. When I'm looking at cyclicals today, I'm looking at the better quality defensive cyclicals, so some of the telecommunication companies, and some of the drinks companies like Diageo, which I still think looks too cheap.
James Bevan, I want you to rationalize 35 times earnings. One estimate of Microsoft is the 12 months forward view is 35 times earnings. Justify owning Microsoft right now.
let me rationalize it by talking about the earnings yield rather than the price earnings multiple, because of course the earnings yield is the price earnings multiple reversed, and an earnings yield of 3% needs to be considered in the context of where cash rates currently are. The equity risk premium payment for taking equity risk relative to cash as the risk-free rate of return does remain relatively elevated, and that puts all of the focus on whether or not we are going to get real growth. And I am in the camp that says we will get a short-term acceleration in inflation. That seems to be absolutely baked in the cake. Nothing we can do to stop that. But I do also believe that inflation is going to come down again. And I would say that that is driven by the demographic changes, disruptive technologies, high levels of embedded indebtedness, and the continuing globalization, and notwithstanding the trade tensions, does mean that there is a lid put on the capacity for domestic businesses to raise costs and prices generally. And that allows me to believe that a 3% earnings yield coupled with long-term growth still leaves a company like Microsoft offering premium returns to corporate debt and also very much to government debt.
If you're listening to markets, though, James, I'm looking right now at earnings that have beaten expectations by 26%, 11% if you strip out financials, versus the average of 5% during earnings seasons. This from UBS's Mark Heffele. How do you explain the fact that you have not seen a cheer from equity traders? You haven't seen this excitement about this growth that's beating expectations in what is expected to be a low-rate world for a long time because of what you just said?
Lisa, I think that one of the problems we have with earnings numbers is that the year-on-year comparisons are flattered by the extraordinary downdraft that we saw in March and April last year. And what investors are looking at is the trend growth rather than the one-off growth for the period. And looking forward, I think that we are going to see well over $180 of earnings for the S&P 500. That allows me to project that index will stand at 4,300 points by the end of this year. And my greater concern is we get to that level earlier on the back of this extraordinary liquidity environment engineered by the Federal Reserve and Treasury. And that would be the moment to take money off the table. But no, I think that index earnings on trend are going well. I think the year-on-year comparisons are therefore going to be ignored.
James, it's good to see you. Good to catch up, as always. Thank you, mate. James Bevan, CCLA Chief Investment Officer. I want to turn to the automakers just quickly. Tesla down by about 1.83% in the pre-market. A conversation on this program through much of this morning about better demand and can we meet that with supply. Have a look at the supply of inventory over at Tesla. Tom, they're down to 8 days of supply of inventory over at Tesla. Things are getting tight for some of the automakers, and that's just one right now. They've been able to meet the demand. They've done okay with the chip shortage. Others, it won't be the same story.
I'm glad you bring it up, John, because with JP Morgan's wonderful weekend note, their Friday note, thank you, Michael Ferroli, buried in there is a real discussion of inventories and the dynamics of inventories. It's a little bit inside baseball, but John, it has a lot to do with how you get GDP estimates ratcheting upwards, and that's what we're seeing right now.
A monster inventory build, at least that's the effort, Lisa.
Yeah, the idea here is that you're going to see these chip shortages, which are so crucial to a lot of the automakers, persist for a significant period of time. A number of chip makers have come out and said that it's going to be years before it's resolved. How do they get that backlog of inventory when all the other automakers are looking for the same types of materials, especially in the electric vehicle space, John?
And do we stay with these elevated inventory levels, Tom? Is that something more persistent after the experience of last year? We've been conditioned by that.
John, that's the money question right now. The word stay, what do we do Q3, Q4, and then the whole worry into how you structure the next year. Granted, that's the wall of worry the market's climbing right now.
What do you think, Lisa? Do you think that's persistent?
A lot of people who I've spoken to in the supply chain world say yes, and that's because of the just-in-time delivery demand that you've seen, because people go to what is most convenient increasingly, and the only way you can be convenient is if you have the goods to deliver in real time. So yes, a lot of people think that will persist.
What What a fascinating time for the global economy. Full coverage continues right here live on Bloomberg TV and radio alongside Tom Keene, Lisa Abramowitz and Jonathan Ferro. This is Bloomberg Surveillance and here is your price action. Up around about 5 points on the S&P 500. Futures advancing a little more than 0.1%. Into the bond market with yields higher, up a basis point or two, 158.27 on 10s, a 7-year auction. A little bit later, some supply in about 5 hours' time. In the FX market, euro dollar 120.83, totally unchanged on the day. Last week, it was the ECB. This week is the Federal Reserve. The 2-day meeting kicks off today, concludes tomorrow. For our audience worldwide, from a beautiful New York City where the weather continues to warm up. I think it peaks tomorrow, Tom. We call it 27 degrees. What do you call that?
We call that transitory.
You call that transitory. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. President Biden's proposal to boost the capital gains tax would hit individuals earning $1 million and married couples jointly earning the same amount. The president is set to unveil his plan tomorrow. It would almost double the capital gains rate for some taxpayers. In China, Bloomberg's learned that Hurong Asset Management has repaid an offshore bond with funds provided by the nation's largest state-owned bank. It's a sign that Chinese lenders are heeding government calls to support the embattled, distressed debt manager. Hurong has more than $20 billion of offshore notes outstanding. General Electric burned more cash than expected in the first quarter. That's crimped CEO Larry Culp's turnaround push after signs of improvement. GE's earnings did beat estimates. Still, Culp sees a difficult environment for the crown jewel of GE's industrial business. That's, of course, GE Aviation. A U.S. company has faced soaring bills for all kinds of materials that they need to do business, and rising demand is helping them pass on those costs to customers. In earnings calls, executives from businesses ranging from Chipotle to appliance maker Whirlpool have outlined price hikes. Their comments back up the data that show inflationary pressures building in the economy. More troubles for British Prime Minister Boris Johnson. Allegations of sleaze and incompetence in his government have picked up. Johnson denied a claim that he had said he would rather see bodies pile up than order a third pandemic shutdown, despite multiple reports. Meanwhile, ITV reports that the Conservative Party had loaned Johnson the money to refurbish his government residence, a highly unusual arrangement. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Rishika Gupta. This is Bloomberg.
right now, the mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, they party, makeup will bounce back.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We have too much pressure on public companies, and we don't ask the rest of society moving on. We are going to put our public companies at a disadvantage. And then more importantly, though, we're not going to get to a net zero. The only way we can change that is getting all of society behind it, not just the few, the thousands of public companies.
Larry Fink there, the BlackRock chairman and CEO. From New York City this morning, good morning. Be sure to stay with Bloomberg for more from the Bloomberg Green Summit. We'll hear from Canadian Prime Minister Justin Trudeau, the former Bank of England Governor Mark Carney, and Blackstone Global Co-Head of Real Estate, Kathleen McCarthy. Looking forward to that a little bit later this morning. From New York, alongside Lisa, Tom, I'm Jonathan Ferro. Your equity market looks like this. An hour and 12 minutes away from the opening bell. Equity futures on the S&P 500 slightly positive, up a little more than 0.1%. Yield slightly higher, up around about 2 basis points to 158.45. And a euro dollar, 120.87, Tom. Muted price action in foreign exchange on a euro.
Yeah, the market's churning here. Maybe we'll see something tomorrow. Look for our Fed coverage tomorrow afternoon as well. But most people looking forward to the June meeting. Right now on the president's speech on infrastructure, John Lieber joins us with Eurasia Group in his important experience with Senator McConnell in Kentucky. John, I want to go down to the reality, which I'm sure you faced years ago with Senator McConnell, which is a bridge over the Ohio River. It is the Brent Spence Bridge, and it's given the president's initiative.
Yeah, that's a great example of a really important piece of interstate of infrastructure that carries quite a bit of interstate commerce and should be a pressing national issue that Congress wants to try to fix. That's really gone neglected for far too long. So, I think the reality is Biden's got the partisan alignment he needs to pass a very large infrastructure bill. One of the biggest challenges of the last 10 years has been the declining revenues in the Highway Trust Fund. That's made paying for these type of repairs extremely difficult. But right now, we're in an environment where the Democrats are basically united around increasing taxes on corporations and wealthy Americans to get this stuff done. And probably by the end of the year, they're going to have the authority to start the money flowing over the next 5 to 10 years to fix these kind of things.
Do you look for a compromise that focuses on projects like the Brent Spence Bridge, or are we going to look for a more omnibus bill?
I'd be surprised to see Republicans even being really relevant in this process, frankly. I think that they have, the Democrats have the votes probably to do most of the infrastructure projects. They've got big ambitions beyond physical infrastructure with this human infrastructure side, focused on childcare and subsidies for education and healthcare. And, Republicans just aren't going to play ball for that. And most importantly, they don't want to raise taxes to pay for it. And that's going to be the biggest stumbling block, I think, that makes this basically a partisan exercise.
And I want to go a little bit deeper into that, given your work with Senate Majority Leader Mitch McConnell, or former Senate Majority Leader. There is a question of whether they would be open, the Republicans, to any tax hikes. When you were working for him, did he talk about the necessity for paying for different projects, or did he believe that things would pay for themselves if you had the right projects?
I think I'd say that the kind of your average Republican member, believes in the user pay notion when it comes to infrastructure. So for a long time, that user pay idea was embodied in the Highway Trust Fund, where gas tax fueled the Highway Trust Fund, and then the Highway Trust Fund was used to pay for surface transportation projects. And now you've got people driving less, cars becoming more fuel efficient, and the gas tax hasn't gone up in a generation. So those revenues are declining. But if you ask, your average Republican if they want to raise taxes on American corporations or a small business owner to pay for infrastructure, the answer is going to be no. And this dynamic is just making it really difficult to get anything done.
Given your experience in Washington, D.C., does a $900 billion skinny infrastructure bill, and it is funny that we're calling a $900 billion plan skinny, does it seem feasible and likely to be the outcome of some of these negotiations?
Yeah, you raise a good point. I mean, it's absolutely wild. 2 years ago, the Senate committee that deals with infrastructure put together a bipartisan bill that was around $400 billion, and it was considered a historic achievement. And now, many of the Democrats that were involved in that process basically rolled their eyes at the Republican $600 billion proposal. And it just shows you how far the goalposts have moved. But no, I think the challenge here is the House. And that even if there were a Senate compromise that ended up around $900 billion, which I'm extremely skeptical of that, the House senses an opportunity here, and Joe Biden senses an opportunity here to go much, much bigger in a way that's going to be really transformative for America's anti-poverty programs and really change the game when it comes to green energy incentives. And that's really what this is about. This isn't about repairing potholes, fixing the Brent Spence Bridge, and doing a couple projects on infrastructure. This is about doing big things to accomplish the Biden agenda. It's why he ran. It's why they think it's why he won. Mm-hmm. And that's their goal.
How does the big things tone fold into the beginning of the run to November of 2022?
Well, November of 22 is an interesting year. I mean, the party in power almost always loses seats. Really, always. I mean, there's very few exceptions to this rule that the party in power loses seats in the midterms. It's possible this cycle is a little different because of the fact that Biden didn't have any coattails. So it isn't like the Democrats have extra members in the House as some majorities do. But, the odds are, and the historical trend would be, that the Democrats lose probably the House and potentially the Senate as well, which means that Biden, like Obama and Trump, is going to lose his ability to do any legislation after his first 2 years. So if you think that your elect came to Washington to get things done, this is your window to do it as a Democrat. And I think ultimately that drives them to a partisan deal by the end of the year.
John, it's good to see you. Good to hear from you. John Lieber there, Eurasia Group. And Tom, on that final issue there, let's just build on that a little bit more. Will there be some payback because some people within the electorate in this country, many people in fact, believe there's been some overreach beyond the mandate that it was given with such a skinny margin in both chambers?
Oh, that's a mystery. John, there's no question that is, if you will, the zeitgeist through the end of this year. But you're going to get into primary season, and that's going to have its own battle. But I'm fascinated where that payback is, John, in the summer of next year.
Lisa,
I don't think anybody knows.
Tom, you said it in early November, the midterms. The race for that starts right now, and it continues, Lisa.
The biggest unknown in my mind is what the economy is going to do. I mean, that feels so far away. And right now, Biden has a lot of popular support, as per that poll that came out over the weekend. But going forward, I mean, talk about the labor market. Can we get back down to some of the lows that we saw pre-pandemic? Can we get inflation that is big enough to potentially offset the debt, but not too big to make it difficult for people to buy things? We just don't know, John.
We could have a four handle on unemployment year end. Great news. But the cost situation, soybeans, wheat, fresh 8-year highs, copper, decade highs. The Larry Summers argument, I think we all know it well by now, Tom. There's going to be some difficulties with inflation maybe. And that will be the experience that people have, regardless of what the Fed tells you. Everyday people aren't going to tune into the Fed tomorrow. I know you'd like them to. They're not going to. It's about what they experience month on month, Tom.
But there's a Fed special coming up. That's what we're going to be doing, and he's promoting that.
Just crushed me.
I think you killed the Fed special yesterday. You think that I did?
People will tune in, find out about inflation. Coming up.
Tom,
Caroline Hyde is in tears.
I'm in tears with the way this is going. Equities up 6 on the S&P. This is Bloomberg.
focus is odor detection. And this is because no matter how you're bound, what container you're in, you're still producing and releasing odors. And we're kind of building off of wildlife detection dogs.
This is basically going to kick off the whole week.
From bank earnings
really have to be front and center,
to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news, Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
A big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America.
There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season. Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Live from New York City for our audience worldwide on TV and radio. Here's the price action on Bloomberg Surveillance. Equity futures grinding higher on the S&P by almost 5 points, up a little more than 0.1%. On the Russell, we advanced by about 1/3%. Morgan Stanley brought this up in the last couple of weeks, and it's becoming to be the story at the moment. Execution risk. Execution risk, execution risk. Demand is good in this economy. In America, can supply meet it? I think Tesla gave us a little flavor of that. Inventories starting to tighten up, a chip shortage. If the demand's there and you can't meet it, what have you got? You've got an execution problem. And that's what Morgan Stanley's getting at. We'll see a lot more of that in the weeks to come. Switch up the board and get to the bond market. 2s, 10s, 30s, 7s. $62 billion worth coming a little bit later from the Treasury. Supply of a maturity that caused a bit of a problem a couple of months back. Will we see the same story again? It's a different market environment, but who on earth knows right now? Your 10-year, 158.27. Your 30-year, about 226 at 225.60. Want to finish on euro dollar? Switch up the board and we'll get to the euro. 121 handle Friday, Monday, briefly. Tuesday, 120.82, and totally unchanged. Totally unchanged on euro dollar, really muted going into the Fed tomorrow, Tom.
Huge stasis, even Turkish lira comes in stronger, Turkish lira this morning. Right now, our conversation of the day, John and Lisa, on economics. Peter Hooper joins us, of course, with Deutsche Bank. His deck on economics, hugely anticipated on Wall Street. Peter, I want to go to the heart and soul of your must-read, and that is simply, you look for upside risk to GDP and an unemployment rate that drives us down to a fully employed America. Balance that for us right now. Will that occur within market stability and national stability?
Tom, that could be a tall order, but look, there's an awful lot driving growth at this current point. We have, of course, the normalization of demand coming out of COVID as people are being vaccinated. We have tremendous fiscal support both behind us and ahead of us here. We think that we'll probably get at least a 0.5 percentage point out of GDP out of what's still to come. But the household income support that we've gotten so far, building up a war chest of household saving that's going to get to something like 10% of GDP, waiting in the wings to be spent. There's no way we're going to see less than 6-7% growth this year. Our own forecast is above consensus at 7.5%. So that's certainly enough to get the labor market by second half of next year back down to the 3.5% unemployment rate that we saw pre-crisis.
In the dynamics that Matthew Lazzetti worked through for you, you coin a phrase and you talk about the Amazonization, I hope I got that right, the Amazonization of the American economy. Do we underestimate the cardboard boxes and the cloud that's out there from Mr. Bezos?
Well, I mean, the good thing, Amazonization has a number of facets, but one very important for the Fed is despite this very rapid growth and a tightening of the labor market, unlike what we've seen for quite some time, Amazonization is a factor that we think is going to keep inflation from getting out of control. Certainly, the vast improvement in information flow about supply and demand of all kinds of commodities and services, price information now globally is going to keep, we think, after some initial disruptions as bottlenecks appear during this normalization process, Amazonization working in the background is certainly going to be there.
Well, but Peter, even at Amazon, we're seeing the pressure in terms of labor shortages, having to offer higher wages to lure people there, not to mention the fact, the effort of unionization. Wow, this is quite a day. Excuse me, but I do wonder going forward.
Do you want us to count you in?
What?
3, 2, 1. You just restart it. Peter Hooper's gone. We'll just restart this. It's the power,
let's
the
restart
power of
this
TV
show.
and radio. You can go again, Lisa. Just start again and we can talk about it right now.
There is a question about whether Amazon is going to face longer lasting cost pressures for a longer period of time, John. I think that Peter hung up because he was just like, forget it. If you can't say Amazonization or unionization, then you might as well hang up.
I think there was a technology problem with the control room. I didn't mean hang up on Peter. Just meant start the segment again and let Lisa gather her words
We are going
get
down
it together.
in flames.
We are going down in flames a little bit.
This is not transitory.
Clearly not. Look, pay forward, pay back rather from pull forward, I think is a concept we need to get our teeth into just a little bit. We got a taste of that last week with Netflix. What about the other big players in the mix here? When we saw a huge acceleration of existing trends through the pandemic, Lisa, and I just wonder whether there will be some payback because of the pull forward beyond just the Netflixes of this world. I want to bring back in Peter Hooper. We've re-established that connection, the Deutsche Bank Global Head of Economic Research and, of course, Chief Economist, too. Peter, great to catch up with you, sir. Let's just round things out with a couple of thoughts on this for the Federal Reserve at the moment. The difference between transitory and persistent. You know, we talk and joke all morning about this, and Tom has a drink because it's the drinking game we play, and I think Vice Chair Clarida joined in recently, too. What is the difference for you? What defines that as the year goes on?
Okay, well, one thing the Fed's been wanting to see is a string of good information on the labor market. I think that's 4 or 5 months of something approaching 1 million on payrolls before they give us any indication they're going to be giving us a hint about tapering to come. There's another issue here is transitory versus persistent on inflation. Yes, we are going to get a bulge in price increases in the middle of this year as growth normalizes, as the economy normalizes. But another thing to keep in mind here, going back to this Amazonization, is we've been well above trend in consumption of goods. COVID meant people dropped back sharply on their demand for services. I think as things normalize, you're going to see a shift back towards services, and that means taking some of the pressure off the goods sector. So, yes, we're seeing a lot of shortages. Yes, we're going to see some real disruptions as these demand patterns shift and things normalize. But we've been encouraged by the extent to which labor supply in the hospitality sector, for example, has picked up. Hiring has picked up. There's an awful lot of unemployed people that need to get jobs still. So there'll be some disruption. We will see some transitory price increases, but our expectation is on inflation, which could get to 2.5% middle of this year, maybe a little higher. We'll be back 2 or below 2% by next year.
Yeah.
That's not a persistent problem.
Peter, what's the economic effect of higher taxes?
So, I mean, looking ahead at what we might get. Obviously, from listening to some of your earlier discussion, a lot of uncertainty about just what's going to go through Congress here. But if Biden gets his program, if we get this 2.25 trillion jobs plan with the corporate tax package to go with it, that's worth about 1%. I mean, assuming roughly 10% of the spending comes in the first year and the tax program goes through as planned, we're seeing about a percentage point of GDP growth out of the spending side, and roughly a half a percentage point offset from tax increases. The total tax increase over the next year, something on the order of, by next year, something on the order of $90 billion, little less than 0.5% of GDP. So yes, I mean, there are all kinds of questions about what impacts the particular form of tax has across different parts of the corporate sector as well as households. But the broad.
Hello, traders again. It's time to place an order to buy euro, and I'm looking to buy at 120.76.6. Okay, just right here. So you still have time to place an order to buy at 120.76.6. Okay. If you want to find out more information about our strategy, you need to go to company.co.uk. Otherwise, follow us for free. You don't have to pay anything at all. You can follow our trades and you can make profit as well, the same way we do. We will guide you through all trades we have. To see what we have for you, you can see it on our ticker on stream. You will see our positions that we opened already, so you will not get confused. At this moment, I can see that we didn't fill the order yet, and look like it changed. It moved rapidly up. Let's try to put little bit. I will move up my order to 120.76.8. Okay. Let's wait. Let's see what's going to happen with two candlesticks, where they will go, and then I will make my decision I'm going to do with this order. For time being, you can place an order to buy euro. Stay safe.
On a US 10-year maturity near the end of March. Looking forward to that chat a
means
little
they're
bit
looking
later.
for lower interest rates?
Potentially over time. And Tom, maybe, Mike Collins bringing up a really good thought, interesting thought, maybe not good for many of you. The idea that maybe the Fed doesn't get away from zero, gets stuck down here because it waits too long. I think conceptually that's something to spend a little bit more time on, maybe later in the year into next year, but something to consider, and something that Michael McKee tried to ask in a news conference in the last one.
Got slammed.
And I think they played elevator music over the top of him.
They did.
And Chairman Powell didn't really respond.
Yes, that is accurate. To me, John, what's fascinating about this is everybody's calling for higher inflation. That has all my radar up.
Yep, and you see it in the research and you hear it on the corporate calls as well. This earnings season, Microsoft later, Apple tomorrow, Amazon after that, the Federal Reserve with a decision in between, and I'm told absolutely stellar, captivating coverage coming up on TV and radio.
Got that right.
Led by Tom Keene and Caroline Hyde and Scarlet Fu making an appearance too, I believe. So looking forward to the coverage tomorrow afternoon. Equity futures up 4 on the S&P. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. This is Bloomberg.
With the first word news, I'm Rishika Gupta. President Biden will propose a large-scale tax increase tomorrow. He'll also call for giving billions more to the IRS to make sure the rich people and large corporations pay all that they owe. Bloomberg's learned that the proposal would raise the top tax rate to 39.6% for those making at least $400,000. The measure's a key element in the president's American Families Plan that he'll unveil tomorrow. President Biden is stepping up pandemic assistance to the rest of the world. The U.S. will share its entire supply of AstraZeneca's coronavirus vaccine with other countries. Plus, it's putting together an aid package for India. All this represents a shift for President Biden. He's been focused on making sure Americans are getting the vaccination first. And Vice President Kamala Harris has pledged an extra $310 million in humanitarian aid to stem a wave of migration from Central America. The money will go to Guatemala, Honduras, and El Salvador. Harris discussed the need for long-term economic growth in a virtual meeting with Guatemala's president. BP is trying to win back shareholders after what's been a difficult year. The British energy company says it will begin share buybacks after what it called exceptional natural gas trading boosted earnings. BP cut its dividend in half last year. Now it plans to return at least 60% of surplus cash flow to shareholders. Eli Lilly has cut its annual forecast for annual earnings per share. That's after the government cancelled an order for the company's coronavirus antibody. Instead, the agreement now focuses on Lilly's combination treatment. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
The sector right now that is telling the most interesting story is consumer staples. Staples are at their lowest relative point versus the S&P we've seen at any point over the last several years. I think the weakness, the relative weakness in staples, the relative weakness in utilities suggests that bond yields probably don't go a ton lower from here.
Christopher Verone, strategist, head of technical strategy there with us earlier today. Lisa Bramlett and Tom Keene. John Farrell prepares to drive forward the conversation at 9 a.m. Barry Ritholtz with us right now, Bloomberg opinion columnist. And Barry, I really want...
We didn't have a chance to buy another contract for euro because it moved up, as you can see. So for time being, the order to buy cancelled. So if you wanted to trade, let's wait for better time for another chance to buy euro. Okay, I'll speak to you later. So for time being, please cancel your order to buy euro. Speak to you later, guys.
Brand new top tier in terms of taxes for the wealthiest 1%. And so in some ways, that's a throwback to the pre-Reagan era. Yeah, absolutely.
Yeah, well, okay, it's a throwback to the 60s as well. What you and I remember is 5-for-1 call deals, commercial aircraft equipment leasing deals where there was a cottage industry to avoid the agony. Why aren't we going to see that again?
Well, it really, the devil's in the details. It really depends on how the tax code is drafted. Keep in mind, back in those days, all those crazy, tax dodges looked at the existing tax code and said, okay, what can we do to hide legitimately this income from Uncle Sam? And so, incentives matter. When you leave an incentive for people to engage in that sort of lease buyback nonsense, the funny thing about it is lots of companies decided, hey, why do I need to own my building or my office? I might as well do a lease buyback and get it off my books after the tax code changed. So, how it's drafted makes a big difference. The incentives involved make a big difference. And if this is carefully crafted without a lot of room for loopholes, well, the expectation is raising taxes on the wealthiest real estate and stock owners is going to generate more income. That'll pay for infrastructure that everybody gets to enjoy.
Barry, how much will this change investment strategies, investing perhaps in more munis or other more tax-protected investments?
It depends on what they do with the short-term rates. I haven't really seen where that wants to go, but there's always been a penalty for traders. If you're looking at Robinhood and those sorts of things, lots of those traders were surprised at how high the higher tax rate is. So you can't, the short-term tax rate at 30%, obviously you can't have your top 1% long-term taxable rate higher than the short-term rate. So there's going to have to be an adjustment there as well. If you're a long-term investor, I don't think there's a whole lot you're going to do to adjust your portfolio. If you're living on dividends, if you're living on income distributions, well, maybe it might tilt the scale towards munis and other income producers. But for the average person with an IRA or a 401k who are saving for retirement, it wouldn't make any difference because it's going to be in a tax-deferred account. Maybe it shifts some people more aggressively towards Roth rather than traditional. But most savers are tax-deferred.
Barry, in addition to being star of stage and screen and audio and print, you also help people manage money. And there is a question of how seriously to take some of the proposals that have been put out there in terms of higher taxes, as well as in terms of some of the infrastructure spending. How do you game out policy proposals in Washington, D.C. when it comes to how much you might make, whether it's in the stock market as a result of people selling ahead of taxes, or whether it has to do with gains due to infrastructure spending?
So the first level, I love that question. The first level of that analysis is assume 98% of what gets floated won't get passed. A lot of these things are rough ideas and outlines, and sometimes there's pushback. So you can't start flipping your portfolio every time something comes out of DC. 9 things a day come out, and you're best ignoring all of them. However, when there's a groundswell, such as there has been in terms of pushback to wealth and income inequality, and when there is an overwhelming demand, as there is for bringing our infrastructure, forget 21st century, I would just like a late 20th century infrastructure in America would be a huge improvement. there's an increasing possibility that something will get passed. My best guess is 40% is DOA, but you currently have 3 tiers of capital gains. 0 if you're making less than 80,000 if married, or 45,000 and change if you're single. 15% above that, below about 400 and change, and anything over 400 is 20. There is a balance symmetry to 15, 20, 25%. So I think 40% is just an opening gambit, and it will end up closer to a 25% number than a 40% number. P.S. If it's 25%, you still have carried interest as a loophole out there. It would make sense with this proposal to close that loophole. At 40%, carried interest essentially becomes ordinary income cap gains. It becomes the same thing for hedge funds, private equity, venture capitalists. If they take the rate, let's call it 25%, then that carried interest loophole would have to get closed as well.
Got to leave it there. Barry Ritholtz, thank you so much. Tax analysis, and look for that from his work at Bloomberg Opinion. Lisa, your thoughts here as we dive into earnings season and Microsoft this afternoon.
The idea here that a lot of companies have beat substantially, and the response has been, what are you going to do for me next week? I mean, basically, traders haven't been responding to that.
I don't disagree, yeah.
I am curious, and to go to James Bevan's point, he's saying, look, in a low-yield environment, the earnings yield on these companies looks that much more attractive, even if it's lower than it has been historically. And that, to me, is one of the tensions. Why is that not holding? Why is that not the story that we're hearing from traders following these earnings?
We call it earnings season, and I really wonder if we should call it revenue season, because companies that have higher single-digit revenue guesses forward, companies that deliver revenue growth seem to be doing okay. Look at UPS. But others, you're absolutely right. It's been a little more challenging than I expected.
It's just surprising, the reaction to it, especially when you have the likes of consumer staples coming out, Coca-Cola, P&G, Procter & Gamble, coming out and saying, yeah, our input costs are rising. We're seeing inflation. It is real, but we can pass it on because our consumers are doing pretty well and you're seeing wages go up. So when does that translate into a renewed push into equities? I just don't know.
36-month, 3-year GDP for Deutsche Bank going out 3 years from now is 4.23%. That used to be called a boom economy in itself, but that's a distortion of where we are right now. Right now, our distortion markets, well, you know, not a snooze fest. It's extremely exciting into the 9 o'clock hour.
Wait to
red and green on the screen.
Woo.
The VIX. Let me give the
Fairly
Dow
red.
because Farrell won't mention the Dow.
Fairly green.
33,859 on the Dow, down 18 points. Microsoft and the Dow this afternoon. This is Bloomberg. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Wednesday, the Fed decides. The Fed is on hold, waiting on inflation. But for how long? Coverage begins 2 p.m. on Bloomberg Television.
From New York City for our audience worldwide, good morning, good morning. The countdown to the open starts right now with equity futures almost unchanged on the S&P 500. We begin with the big issue. Can corporations meet big expectations?
This collision between expectation and reality is playing out.
Earnings estimates are chronically being upscaled.
The numbers continue to beat expectations.
As the earnings reports come in.
Given all of the concerns around inflation,
we want to see how much higher costs have cut into margins.
We haven't seen that yet in terms of pricing power.
Companies have been, I think, remarkably resilient.
But you also want to see how stocks are reacting to the news.
Some of the responses to earnings,
the reactions in single stocks,
might not have been as robust as one would expect given the strength.
We want to make sure that doesn't become a trend.
As that cycle matures, I think the bar gets higher.
The execution risk, to me, that's the biggest thing.
Execution risk. That's the line from Morgan Stanley. Let's bring in the Bloomberg team. Kaylee Lyons and Abigail Doolittle. Morning, Kaylee.
Morning, John. Well, just under a third of companies within the S&P 500 have reported results thus far, and by and large, they do show a robust earnings recovery. More than 3/4 of them have seen earnings grow on a year-on-year basis, on average by more than 45%, and about 77% of companies have beat earnings expectations by about 32% on average. Granted, sales growth and beats have not been as notable, but still the majority of companies are seeing revenue growth and topping expectations. Given all of that, you may think companies may be reaping some reward for those results, but not so. The average share move in the day after reporting is 4 basis points, not even 0.1%. It really just goes to show you how lofty expectations were going into these prints as analysts continually raised their earnings forecast, lifted the bar higher as we came into earnings season, with better results now coming in. The average EPS growth forecast now sitting at 34% for the period. That's up from just 21.5% at the beginning of March. And as we look further out into the future, John, you can see those earnings expectations going up and up. Right now, the consensus forward 12-month EPS estimate for the S&P 500 is right around 178. Contrast that with the trailing 12-month EPS of 129.61. Yes, the forward look is pretty much always ahead of the backwards looking one, John, but the gap between the two has gotten quite extreme, John.
Kelly, thank you. Big issue this quarter. Demand's good. Can supply meet it? What is going on with prices? Let's bring in Abby for more. Hey, Abby.
Hi there, John. Well, there's certainly no doubt that U.S. companies are facing soaring bills in terms of costs and inputs as materials are absolutely rising, not only this year, but over the last year. All kinds of input goods, the prices are climbing. That, however, they are able to right now, in a healthy way, pass along to the customer only because demand is so strong. So we keep hearing about these supply chain kinks. So if we go into the Bloomberg terminal, or it may actually be a regular board, we are going to see that PPI, the cost of goods as they leave the factory, are at a decade high. So those costs are being passed along. So is this true for the price coming out of Business services, the cost for the ISM services also very high. Right now, as you know, that CPI print for the last month was not all that high. The question is, down the road, will these soaring costs at some point catch up with demand and create a problem? It's not the case right now, but it could be an issue down the road. As for those input costs, if we take a look at grains over the last month, we are going to see huge, huge gains. This is just 1 month. And then there's copper up 100% over the last year, lumber soaring. So all of these assets, these goods, these commodities climbing, creating a problem for companies. The bigger question, though, John, will it hit the bottom line? Not right now, because margins are higher, up about 12% for this first quarter of the companies that have reported, much better than the 9.7% last year. An easy comp, of course, expected to hold steady in the second quarter, but at the end of the year, are these soaring costs, are they going to eat into the bottom line? We will find out.
Abby, thank you. Can we put that month-to-date board up again for lumber? Up more than 50% month to date. The 1 month moves of some of these raw materials, these commodities, unreal. Soybeans up by more than 10%, wheat up by more than 20%, corn up by almost 20%, lumber up 53.35% over the last month. Absolutely unreal. This is where the conversation is at right now. So I wanted to start the program doing a couple of things. Putting the work of Morgan Stanley together with the work of Bank of America. Morgan Stanley warning that rising costs still aren't priced in. Quote, this is from Mike Wilson and the team. Dreaming of a reopening is easier than actually doing it. We see growing cost issues in the near term that aren't priced. There is also a question of how much pent-up demand really exists. We continue to recommend moving up the quality curve and reducing beta. Wanted to add in what Bank of America are looking at, what they're hearing on earnings calls, and what they're hearing increasingly is the word inflation. Mentions of inflation more than tripling year over year, and calling that, quote, the biggest jump in our history since 2004. Raw materials, transportation, labor, etc. were cited as major drivers of inflation, and many plan to, or already did, raise prices to pass through higher costs. I want to bring in PGIM's Michael Collins to start this conversation on this topic, this debate. Mike, your take, please. What is happening with price pressures at some of these companies?
John, as you pointed out, we've seen a big improvement in productivity among companies, which has allowed them to raise their profit margins, which gives them the flexibility to absorb some of these higher input costs. Now, for sure, some of that will be passed through, but in many cases, I think these companies are going to absorb these prices. And remember, what's priced in is really important. This is the whole focus of your introduction here, right? What is priced in and what's going to happen? And really high inflation is now permanently priced into our economy. And I don't think that's going to come to fruition over the long term.
Let's put some numbers on really high inflation. Really high inflation, Mike. How high? And what's permanent about it?
2.5% a year, almost indefinitely, is what's priced in right now. If you look at the TIPS market, Jonathan, the Fed, as you know, has had difficulty hitting 2% inflation for decades now. This year, yes, you will see two-handle inflation numbers. There's no doubt you're going to have inflation in the twos, maybe 2.5, maybe 2 3/4. But in 3 years from now and 5 years from now, where is inflation going to be, right? I actually believe maybe even as early as later this year or in a year from now, you're going to see these month-over-month changes in prices start to come down. You might get disinflation start to kick in earlier than people think. Those numbers you just showed, those 100% increases in prices of goods can't continue, right? So at some point you will have a deceleration, and I don't think the markets are pricing that in properly.
You clearly don't think this persists. You clearly think we've priced in a lot of price pressure already, Mike. And I understand that you're already looking at duration, have positioned for some longer duration in a portfolio recently. Is that the reason why, Mike?
Absolutely. The big debate you're having today, Jonathan, and that we're having in our shop, just in the last 24 hours, we've spent a lot of time really trying to figure out what the trajectory of this recovery is going to look like, and when it's going to peak and when it's going to decelerate. And it's peaking right now, right? I mean, it is the next 3 months, maybe 6 months, is going to be peak rates of growth. Maybe you've already had peak rates of growth in a lot of things. Our recreational vehicle analyst was on the line this morning. RV demand has doubled, right? It's not going to double again, right? So you're almost at these peak rates of growth. And what we've done is we've looked back. If you look at the rate of growth of things like industrial production, and you look at the treasury yield, they tend to coincide. Yields tend to peak when the rates of growth peak. And we're going through a peak growth rate right now, right? So that's why we are emphasizing longer duration posture.
So, Mike, you're willing to say that for this cycle that we might have already seen the peak in yields?
Yes. Yes, I mean, we hit 175 on the 10-year, Jonathan. As you know, that is effectively pricing in, what I call the Fed's perfect world or dream scenario, where they can get the funds rate above 2%, maybe even as high as their 2.5% target, and keep it there indefinitely. That's what was priced in when the 10-year hit 175, when the 10 years forward hit 3.25, and those rates have come down already, starting to reflect what the world is going to look like in 3 and 5 years from now.
So, Mike, you've got everybody's attention now. Let's build on this a little bit more. Ultimately, what I thought would matter through the cycle is the cumulative improvement that drives an ever tighter labour market and ultimately gets us to think about higher labour costs, higher price pressures that are persistent. Why is that less important compared to peak growth that you think we've already seen?
Well, remember, John, we just got the census numbers, right? Our population is growing at the slowest rate. It's grown almost on record, right? You have this aging population, these higher tax rates that Biden's proposing. What's that going to do? It's going to cause people to leave the workforce. Why work if you're going to have to give half of it away in taxes? Ultimately, in the near term, you're right. You will see labor markets improving. You will see the supply of labor coming back online, and you'll see the supply of chips and production increase to meet the demand, right? I think that's another thing people are missing. They assume as the labor market picks up, demand will increase, but supply also improves, right? A lot of these bottlenecks are a result of people leaving the workforce, people being forced to stay at home. As they come back in, you'll see supply ease. I was on the line with our semiconductor analyst this morning, and he's saying, hey, by the end of the year, the auto companies are expecting an ease in the tightness of chip supply. So it will happen, Jonathan.
So, Mike, couple of points here. First one, on the 10-year, you've made a big call that we may have already seen the high in the 10-year yield, not for the year, but for the cycle. Next call, you think we might get stuck here down at 0 on the Fed funds rate? Is that right, Mike?
Yeah, right. We already know, Jonathan, the Fed is going to be more patient than normal in hiking rates. They're going to start maybe reducing their bond purchases, i.e. tapering, maybe later this year, maybe early next year. They're going to let that play out for a year or so. They're going to see inflation above 2% this year, but they've already told us that they are not going to pay attention to that. Their clock on inflation is going to start ticking next year. And as inflation starts to roll over in years 2, 3, and 4, and growth peaks here and maybe starts to revert back to 2 or sub 2% growth in 2 or 3 years from now.
Yeah.
There's a really good chance that the Fed waits so long to hike rates that they're unable to. Last cycle, they almost made that mistake. They were able to hike aggressively very late in the cycle and quickly reverse that. That could also play out this
With that in mind, I'm fascinated to find out how you're positioned in credit, Mike, and we'll do that in a couple of minutes' time, so stay close. Michael Collins at PGIM, sticking with us. Let's turn to this price action in this market. Just a ton of earnings, Abby, through today and through the rest of this week.
Indeed, it's all about earnings. And starting out with the big one on the morning, Tesla shares are down. This despite the company reporting record profits, also recording a Bitcoin gain. What folks don't like is the fact that the company did not offer specific deliveries guidance for the year. So that stock down 2.7%. That could also be a reflection of the fact that this stock is up 8-fold over the last year, too far, too fast. GE down 1.1%. They put up a solid quarter, but they burned more cash than expected on the jet unit drag. Eli Lilly down 2.6%. Their full year adjusted EPS misses the estimate. A big winner on the morning, though, John. UPS up 8.9%. This is a sign of the economy recovering, vaccines getting into the economy, helping that growth. They beat and they raised their forecast as well. And JetBlue up 0.9% off the highs, but nonetheless a nice gain there after they beat operating revenues. And they are talking about a glimmer of hope going forward in terms of vaccines getting into people. Travel will be renewed.
Abby, thank you. Coming up on the program, the details of President Biden's tax plan slowly filtering out with anticipation building ahead of tomorrow's address. That conversation still ahead with PGIM's Mike Collins and Woody Caesar of Wells Fargo Securities. From New York City this morning, good morning. Equities up 3 points on the S&P, 4182, and up almost 0.1%. This is Bloomberg.
model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
President Joe Biden, nearing 100 days in office, addresses a joint session of Congress. COVID, the economy, the plan forward. Wednesday, 8:30 p.m. on a special edition of Balance of Power on Bloomberg Television and Radio.
We're talking about a tax change that would affect, again, the 0.3%, the top sliver of households. And number two, the principle here is to equalize the treatment of ordinary income and capital gains.
The Joe Biden administration discussing the president's plan to raise capital gains taxes. The tax hikes will pay for his Americans Families Plan, which he's unveiling in an address to Congress tomorrow. Biden also planning to raise personal income tax rates on top earners and corporations and give $80 billion to the IRS for audits of the super wealthy. Bloomberg International economics and policy correspondent Michael McKee dropping by the studio. Morning, Mike.
Morning, John. Bad news for you, not just for the super wealthy. They want to increase tax enforcement across the board. Now, the Biden plan for the economy depends on two thoughts. One, that the U.S. needs significant rebuilding of its economic capabilities, infrastructure, and two, that the wealthy are undertaxed. And that brings us to how you're going to pay for it. It's going to be a tough sell to the wealthy, the idea that they have to pay more. They're also the largest political contributors. So you can expect a lot more of Brian Deese and others coming forward to defend the president's plans. One thing, capital gains taxes, most people think of it as stock, but only about 25% of them come from stock sales. The largest percentage comes from what's called pass-throughs, where the income of the company is the income of essentially the owner. We've seen a big increase in the number of companies that set themselves up now as pass-throughs as capital gains tax rates have gone down. This is particularly true of our friends, the hedge fund managers, and of course, doctors, dentists, lawyers, people like that. So by itself, a capital gains tax increase wouldn't raise a lot of money, but forcing a lot of that income back into the personal tax category probably would. So you can expect to see the administration push hard on that. Now, those who are arguing against this say it will cripple business investment and it will really hurt the U.S. economy in the long run. So here's the defense the administration is going to put up. That's the 1950s. The individual tax rate, the top rate, 92%. And capital gains were taxed at an average of 25%, higher than they are today. And you can see that business investment took off. And also, GDP grew at a very healthy rate, faster on average, about double on average what we get these days. So the administration is going to make a strong case for doing this. Now, the president's going to compete for time tomorrow with Jay Powell. What does the Fed think of all this? Powell will no doubt get asked and dodge and duck and bob and weave and try not to answer that question at all. But basically, they're going to be interested in one thing, and that is the skyrocketing debt, however it's paid for. If it's not completely paid for, is that going to affect interest rates? Over the last 30 years or so, we have seen the U.S. debt skyrocket over the two recessions, and interest rates come way down. So that's going to be what Jay Powell's looking at, even if he's not talking about it, John.
And Michael McKee, no doubt. Looking forward to the coverage tomorrow. Thank you. Joining us now is Winnie Caesar of Wells Fargo. Mike Collins of PGIM still with us too. Winnie, I want to start with this quote from Mohammed Al-Arian today in Bloomberg Opinion. The Fed should seriously consider following the Bank of Canada's example by initiating a gradual and careful retreat. The longer it takes to do so, the harder it will be to pull off an eventual normalization without risking both significant market volatility and damaging what should and must be a durable and inclusive economic recovery. Do you agree with Mohammed, Winnie?
Good morning, Jonathan. It's good to be here. I think I do agree with him in part. The Fed has definitely kind of overjuiced the economy with accommodation that I don't think many of us could have even dreamed up 18 months ago. And the longer that they hold in this very accommodative state, especially as the labor markets recover, the economy recovers more generally, the harder it is going to be to move off that. And for corporate credit in particular, we've seen companies say, wow, look, my borrowing costs are at an all-time low. I'm just going to go ahead and tap the market and put cash on the balance sheet for, you know, that theoretical rainy day that's going to come up down the line. And with growth being as strong as it is, there's really no incentive for corporate borrowers to start to deleverage or proactively manage balance sheets. So kind of like the U.S. government, you're just going to continue to see debt balances balloon and balloon until the Fed starts to say, okay, we do need to actually start to tighten our policy a little bit.
Let's talk about credit. Mike Collins, I was looking forward to getting your response to this. Triple C bonds, Molly Smith, a friend and colleague for both of us as well, Mike. I know you're familiar with Molly's work. Triple C bonds have dropped below 500 basis points, a level only seen twice in the last 2 decades. And you remember the timing of when we dropped below 500 basis points on Triple Cs. Mike, where do you go? You've given me your story around rates. What does it mean for credit?
Yeah, so Jonathan, one thing we talk about in our shop is what has more scope to fall, interest rates or credit spreads? And I think we almost all agree that rates over the next few years have more scope to fall than credit spreads at this point. But that being said, it's a really strong fundamental environment for credit. As Winnie said, companies have ample access to liquidity, so they're pushing off their maturities, they're lowering their interest expense generally, their debt servicing costs have really come down, earnings, as you know, are going to surge this year, so we're in a unique part of the cycle where credit fundamentals are going to improve. That being said, valuations have become stretched in parts of the market. So what we are doing is we are starting to upgrade the quality of the portfolios, where everybody's reached for yield. Everybody's been forced out into high yield, into lower rated high yield. The sweet spot in the high yield market right now is the double B part of the market. Even longer duration double Bs are more attractive to us.
Is that your take too, Winnie? Get up in quality.
So we have a little bit of a nuanced view. We like the barbell in high yield. We do think that there are some up in quality opportunities. We like high yield technology because on a spread basis, there's actually a lot of room to run with incremental compression relative to some other sectors which are trading very close to or actually through cyclical tights. But we also think that the Triple C market does continue to have some very attractive carry to offer. If credit fundamentals are okay and the Triple C market is highly aligned to the consumer discretionary complex, which by all accounts should benefit pretty significantly in the near term from consumers being able to actually go out and spend the dollars that are sitting in their pocket, then Triple C's, you know, north of 5% feels like a pretty compelling trade, especially if inflationary pressures are going to make real yields feel pretty terrible in those lower yielding, higher quality segments of the market.
Winnie, just quickly, just to jump in, because we've got a little bit of time left, I want to make sure we get to this call of yours. You like the financials too, despite the fact, in fact, because of the fact we've had all this supply. Why is that, Winnie?
So one of the things that we're looking forward to is continued heavy new issue supply across the world of investment grade and high yield. Financials, they've already gotten that out of the way, and everything came to the market and priced pretty cheaply. So now, relative to everything else, financials looks pretty attractive, particularly if we get really heavy new issue supply in May. Some estimates are calling for 150 to 170 billion. That would be a pretty big number to swallow. So the relative value for financials versus the industrials complex actually looks pretty good right now.
Interesting. Winnie, I just wanted to squeeze that in because it's a really interesting call that you've made. I want to make sure we highlight it. Winnie Caesar, come back soon. Mike Collins, on rates, got our attention, didn't he? Mike Collins of PGIM, thank you, sir. Coming up, the analyst action you need to know. That'll be next in our morning calls. And later, the reflation trade debate heating up with value stocks still underperforming. That conversation just around the corner with Nuveen Sarah Malik and Keith Lerner of Truist. This is Bloomberg.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
About 5 minutes away from the opening bow this Tuesday morning. Good morning from New York City with equity futures up 4 points on the S&P 500, up about 0.1%. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin first up with MoffettNathanson downgrading Verizon to neutral, 57 price target. The analyst expecting future headwinds stemming from intensifying competition. Your second call, Credit Suisse upgrading Charles Schwab to an outperform, $86 price target. The analyst expecting shares to benefit from rising interest rates. And finally, Berenberg upgrading UPS to a hold, a $150 price target. The analyst highlighting the company's impressive sales growth after earnings top quarterly estimates. That stock is flying, 190.70, up 8.5% going into the opening bout. We'll cover the earnings next. What a slate we've got coming up for you. Microsoft, then Apple, then on to Amazon. This is Bloomberg.
it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
25 seconds away from the opening bell. Equity futures just about positive. The big three reporting earnings over the next 3 days. Microsoft, onto Apple, then onto Amazon. Equities up about 0.1% on the S&P going into the opening bell. We are up about 1/3 on the Russell, up 1/10 on the NASDAQ. There's the bell. Switch up the board and get to the bond market. Mike Collins of PGIM with the call of the morning. Maybe we've already seen the peak in the 10-year yield, not for the year, for the cycle. You write to PGIM and talk to Mike Collins about that. I'm fascinated by it. I'll have my own follow-up a little bit later. 158.98 on a US 10-year, up a couple of basis points on the day. Euro-dollar stable, unchanged at 120.79. A two-day Fed meeting concludes tomorrow. In the commodity market, up 0.9% on crude, $62 and around about 50 cents. That's your cross-asset story. Let's get the movers at the market desk. Here's Abby.
John, let's start out with a real bright spot, and that is UPS. Shares are opening at a record high. This after the company put up a huge quarter. They beat on earnings, helped out by huge sales. They're seeing a strong economy, but interestingly, and I misspoke earlier, they did not offer a forecast citing economic uncertainty. So even though they are seeing economic strength, they're not entirely sure about the future. Nonetheless, investors loving the report overall, up 8%, again, an all-time high. As for some earnings movers that are going in the opposite direction, Tesla's down 2.5%. They put up record profits. They recorded a Bitcoin gain, but they're not offering specific guidance on deliveries for this year. For a stock up 8 times over the last year, investors want more. GE down about 1% off the lows. This after they reported more cash burn on their jet unit than expected. A little bit of a chink in Larry Culp, the CEO, his turnaround plan. 3M, this is a little bit of a puzzler. We'll be digging into this on the day, down 4.3%. They put up a 20% adjusted earnings beat. They beat sales by about 5%. All segments beat, but the stock is down. So again, we will be digging into that on the day. And then, John, you were mentioning the big ones, Microsoft and Apple after the bell. Microsoft down slightly. It'll be interesting to see what they say about the cloud. And then, of course, enterprise versus the consumer as folks start to go back to work. Alphabet basically moderating. And that's true, too, for the other big ones later this week, Apple and Amazon. So much market cap on that one board, John. I think it's close to $5 or $6 trillion reporting over the next few days.
Unbelievable. 2 minutes into the session, about 4 points away from an intraday record high on the S&P 500. Right now, the price action looks like this. On the S&P, we advance almost 0.1%. Top of the pile, energy up 0.75%. Bottom of the pile, materials down 0.75%. Abby mentioned the earnings calendar. Can we get up the earnings calendar just right now and take a sneak peek of what it looks like today, Wednesday, Thursday? Unreal. Microsoft and Alphabet a little bit later, then Apple, the big one, Wednesday, Amazon clearly the big one Thursday. I'm really interested in the execution story here, the likes of Ford, the likes of Boeing, what is happening with the big manufacturers, the industrial story, what is happening at Caterpillar. Those kind of stories get your attention a little bit more this earnings season as we start to talk about higher costs, higher unit costs as well. Let's bring in Bloomberg's Kelly Lyons for more. Hey, Kaylee.
Yeah, John, we're definitely both watching that story. By the time this week is done, about half of the market cap of the S&P 500 will have reported, so it is a big one. And as for what the backdrop looks like when we are looking at these results, we know what the story was coming into 2021. It was small caps instead of large. It was value over growth. But in the last month, we have seen that kind of flip on its head, and that value has once again started underperforming. Small caps are lagging. The cyclical trade just running out of steam, a bit of a rotation out of the rotation. But there is a building consensus that this was just a temporary phenomenon. Dennis DeBusschere over at Evercore saying it's time to re-engage the cyclicals as the economy reaps the reward of the fast vaccine rollout. He says that'll put upward pressure on inflation, bond yields, and that group of stocks. And it looks like investors are already starting to tilt back that way. Last week, the small cap Russell 2000 beat the tech-heavy large cap NASDAQ 100 for the first time in about a month. It also outperformed the S&P 500. And part of that may be because of the earnings story. Right now, the smaller the company, the bigger the reward for results. Micro-cap stocks on average moving to the upside by 1.6% the day after reporting, small caps by about 0.9. Compare that with a move of just 4 basis points for the large cap S&P 500. And the bullish tone coming from earnings calls could be boosting reflation plays as well. Savita Subramanian And the team over at Bank of America pointing out their gauge of sentiment from S&P 500 members that have reported first quarter earnings thus far has climbed to a record. And they say that increases in that score tend to coincide with outperformance from cyclicals like financials and materials. John.
Kelly Lyons, thank you. Let's talk about that reopening trade. This is the take from JP Morgan's John Norman. Take a listen.
The bigger question you have to ask is, why isn't the rotation happening? Why isn't value outperforming growth on a consistent basis as the numbers continue to beat expectations? I think that's mostly related to some of the influences from the fixed income market, but I think yields will go up. I think oil will move up. I think these fixed income influences are going to support the value rotation, and then you're going to start to see a very classic sort of improvement in asset markets.
Let's bring in Nuveen Sarah Malik for more, and Keith Lerner of Truist as well. Sarah, your line, the economic tide no longer lifts all boats. What do you mean by that?
Well, what we mean is that our main concern right now is with this impressive earnings season, how much is already priced in and has the easy money been made? And we think the market's going to shift in two ways. One is that the rising tide will no longer lift all boats. The lower quality companies are not going to perform as well as higher quality like we've seen over the recent months. And also this means that we need to be more selective. This is going to be a market that is not so focused on growth versus value, but focused on those companies that can beat earnings estimates. And that's why we tend to favor small caps, consumer stocks leveraged to the reopening, industrials because of infrastructure spending, and financials. These are companies we think and asset classes that can beat earnings going forward. And that's going to be the key.
I just wanted to ask Keith whether this resonates with you. It's something I hear a lot on this program.
It does. As we look back at things, Jonathan, the value trade got really extended on a short-term basis in March. But we think it is a pause. We think there's more upside because these companies are showing more leverage to the economic upside, as mentioned earlier. I know there's a lot of concerns about the cost side. We heard about these also cost concerns coming out of 2009. What's really interesting, Jonathan, this year, and people saying, hey, the stocks aren't reacting to the earnings. Well, we went up 7% into the earnings season, so we did front load that a bit. And what's also interesting and noteworthy is this year, forward earning estimates for the S&P are up about 11%, and that's also the same amount the market's up as a whole.
We've had a great rally over the last 6 months, that's for sure. Sarah, you've pointed out the greater emphasis on stock selection, and I do think it's important. You've also pointed out that the companies that generate consistent growth, that's more important than the year-on-year mechanical pop we're set to see this year. Could you just walk me through with a little bit more detail where you find those companies at the moment?
We're finding them in small caps. That asset class is leveraged to higher inflation, higher interest rates, and we're at almost 2-decade lows in terms of small cap versus large cap valuations. So these are companies leveraged to the reopening, like Brunswick. This is a boat engine company. As people go back to boat shows, boating is going to be a great activity for this summer. Inventories are low. We think they're very well positioned. And also companies leveraged to economic growth, like Altra, which is leveraged to the Class 8 truck market, automation, electrification. They made a good acquisition that they're integrating, and strong free cash flow. So again, these companies should do well, not only as we exit the pandemic, but they have that ability to beat earnings going forward because of the structure of their business model. And as I mentioned, you could find that across growth and value going forward. So it's less about that and more about what do you want to own within those categories, because we don't think styles are going to lead consistently going forward.
Sarah, where do the likes of Owens Corning fit into this?
So Owens Corning is a roofing insulation leveraged to the housing market. Again, another area that still median housing starts. They're at median levels, so they're not at peak levels yet. We think there's still more upside there. Low inventories, well positioned as people continue to focus on where they want to live in their homes. That's another name that we like, as well as another company named Terex, which makes aerial work platforms, very leveraged to the resuming of infrastructure spending and construction. They've managed the company well, no debt due till 2024. And it's important to find these companies that are survivors going forward. They can make it through the pandemic with a strong balance sheet so that they are well positioned for the leverage going forward.
Keith, an additional factor here is execution risk. I think it plays into this. It's not going to be sector versus sector. As Sarah points out, it's within sectors. Who are the winners? Who can execute in the coming quarters? Is that a difficult one to read at the moment, Keith?
It is, but I will say, I mean, we're still seeing pretty good breadth. I know we're talking about things narrowing a bit, but we have, over 90% of stocks in the S&P above the 50-day average. So we have a pretty broad-based rally. I would say, you still want to go where the economic leverage is. We talk about financials. Financials just made a major breakout above the 2007 high. Only have gained about 15% over 13 years. We think that's a major breakout. That is positive for the overall value trade. But I agree that, coming out of a market low, the initial rally is the junk rally, right? It's a valuation expansion. It's the lowest quality companies that are now going to be able to survive, win. And now you're moving to something where you really should focus more on earnings momentum, because the valuation of the market is likely not moving higher. It's probably as good as it gets as far as the valuation side, because financial conditions are so loose already, so they're not going to get any looser. Monetary policy is not going to get any looser, and we have some taxes on the horizon as well.
Guys, stay close. We'll continue this conversation on the tax hikes too. Sarah Malik, Keith Lerner. Let's head back to the market desk. Really close to intraday record highs on the S&P. Here's Abby.
There is certainly a risk on tone, John, and a piece of it is the rebound in Bitcoin. Bitcoin almost back at $55,000. It's per Bitcoin. It's unclear whether or not this is a relief rally or the start of a new big leg higher. Oh, at this point, we actually have Coinbase trading lower, so off of the pre-market high. So some folks questioning this, but we do have some strength here for these Bitcoin names. But it's important to notice that Coinbase declined because it had been sharply higher in the pre-market. It tells you there's still jitters around that Bitcoin base. As for the two top sectors on the day, we're looking at energy and the banks. Energy higher with oil. Hess Corp also reporting that they have a new oil discovery. They report tomorrow. Occidental Petroleum climbing with oil. And then we have the banks climbing with yields higher, but not a huge rally, but a moderate rally, enough to put them among the top sectors. And then playing it forward, John, of course, is all about the big earnings. Tonight we will have Microsoft and Alphabet. And it's interesting to note both of these companies are down into that report. That, of course, could have a small impact, could have something to do with rising yields, questions of valuation. But overall, it is that question of valuation. Hearing a lot about too far, too fast. Can these companies continue to deliver? We will know after the bell, John.
We will. Abby, thank you. Coming up, worlds apart, countries around the world pledging to help India fight the pandemic, just as the United States continues easing restrictions. That conversation will continue with Nuveen Sarah Malik and Keith Lerner of Truist. This is Bloomberg.
Right now, the mask fashion is not really favorable to makeup, but we know that, and we are convinced that when the pandemic is over, when people get back to a normal social life, when they meet each other, they party, makeup will bounce back.
Renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and deaths. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
This is basically going to kick off the whole week.
From bank earnings really have to be front and center, to tech earnings.
The COVID boost is gone.
Bloomberg breaks the numbers as they drop.
Breaking news: Bank of America seemingly reporting earnings, and those trading beats are significant.
And furthers the conversation.
Big portion of the economy is up and operating very well.
There definitely is more to go.
No one delivers the data faster.
We need to talk about earnings in America. There's a pretty clear trend emerging.
Bloomberg Television, your home for earnings season.
Vaccine nationalism and inequity doesn't work.
The situation in India is beyond heartbreaking.
I would urge those countries that are not sharing or exporting to do so.
This is where public health interventions are critical.
WHO is doing everything we can.
We are working nonstop across the government.